Good morning, good afternoon, and good evening to the rest of you. Welcome to another episode of Bitcoin Magazine Live. It is I, your host Q, coming to you yet again from my mother's basement, and I'm joined by my co-host P. How goes it, P?
It goes great, as always. Just had to go give my rabbits some ice, frozen blocks of ice. It's going to be 100 degrees here in Nashville, and, got to keep them cool.
Oof. Stay cool. Stay dry. Oh, I guess you're going to be dry as hell. I don't know. What are we talking about today, P?
I mean, whatever the fuck we want, man. There's some.
Well, that's usually how it goes, but
yeah. There's been some interesting news. This is news and notes. We had the excellent suggestion that we should change this segment from news and notes with P and Q. There's a couple of thoughts out there. I'd love to hear people's thoughts in the chat, but mind your P's and Q's, an obvious reference to a human language saying that everyone knows has been yelled at by their parents since childhood. Maybe that's just me. I had a British father. Another suggestion was two guys, one letter, which I feel like is a reference to great video. What do you think, you? Where are we going with this?
I want to just address really quickly. Yeah, we called this today's stream Fiat Currencies Are Dead. Our guest today is going to be Nik Bhatia, the author of Layered Money. He's a friend of the show. We've had him on once before, so we're excited to have him come back and join us. He has been tearing it up with his blog posts as well as on Twitter. Just recently actually dropped an educational video that he's working with Michael Saylor on. So we're going to have a lot to talk about, but he has a lot of thoughts just on the impending recession, Bitcoin's correlation, and where we're going to go from here. So stick around. We'll be having that conversation in about 30 minutes. And then once that's done, we'll have a new episode of Fedwatch with Ansel. And I believe CK is back this week. So got a jam-packed episode for you guys. And we're going to kick it off with some P's, minding some P's and Q's. I didn't like that.
Two guys, one letter. I think that's what we're calling it now.
Two guys, one letter is better. Throw it in the chat. Comment in the chat with what you prefer. P's and Q's, two guys, one letter, or news and notes.
Yeah, I mean, Q, I think when CK introduced you and I, he was very clear that the thing that he was most excited about, I mean, you guys have been friends for years. You were at his wedding. But he basically said,
doxing me, bro.
What? I mean, come on. Like, it's the strength of the community, something, hand-waving statements that make this, whatever. The point is, he told both of us that he didn't give a shit about the fact that he's known you for a while. It was purely based, the reason he brought you into the org, and me as well, was because he was trying to create this, what's it called, like a super band or a super team between us, not based on our talents, but simply because our names are both one letter. And I was appreciative and insulted and also excited. How did you feel about that?
I mean, I've always been defined by the one letter in my name.
Yeah.
Hence the Twitter and Instagram handles Q like the letter, because I had to repeat that phrase so many times on the phone when I would leave word at my old job that I genuinely changed my Twitter handle to Q_, like the letter. No, all one word, like the letter. Yep, no, spelled Like. Anywho, Chris, you sent us a very interesting article, and I'm going to read the too long didn't read portion, but Coinbits tweeted out the Bank of International Settlements just published a 41-page paper titled The Future Monetary System. Too long didn't read. Bitcoin no bueno. Buy our CBDC shitcoin. When will we learn? When will we learn? I guess never.
Never is the answer.
The answer is never. Like, we're just going to continue to recreate the same fucked up systems over and over and over again. And in different variations, because I think, and maybe this is what we'll use this time for right now as I'm talking, because all I do is talk. Let's really break down some of the points that we each individually find wrong with just the fiat system, and then highlight how, hey, your favorite shitcoin literally recreates this in the same way that last week, for example, when we had Tom Longo on and he was touting whatever his shitcoin of the week was, I brought up, I was like, we're sitting here bashing the Federal Reserve. We're sitting here talking about how the Fed and these people really don't understand how to control money. But all you are reintroducing with something like Monero is you're replacing Jerome Powell with someone with less supervision and less regulation to, in essence, have less roadblocks to stop this person, this entity, this business from doing whatever they see fit. So I will start by saying DeFi as a whole, like that slogan, the idea that an individual or a business knows better than the market, I think is a fallacy that we need to get rid of. I think that will be the hardest thing to get rid of because that involves a lot of power leaving hands from one party, such as the Federal Reserve or the centralized government, or Andreessen Horowitz and all the VC money that's been pouring into your favorite shitcoin. All of these things are centralized control, but they tell you, no, it's decentralized. Because there's so many parties involved, it's decentralized. It's like, do you know what decentralized means?
The answer is no, Q. They don't know what decentralized means. Yeah, I mean, I think one thing I do want to say is I think that Monero is at least trying to be something separate. There are problems that I have with Monero, and I think it's like doesn't actually serve the purpose it's intended to serve, which is why I'm I consider myself a Bitcoin maximalist. However, so I think it's important to make the distinction between like things like Monero, which is a privacy or attempts to be a privacy focused token, but has some issues in my opinion, versus the kind of what I would consider to be like the CeFi or centralized finance systems. And to your point, I mean, really, what we've talked about this recently, but my problem with platforms, shitcoin platforms like Ethereum, and as I love to say, Ethereum is the anus through which all the shitcoins are shat out into the world. It's like Pandora's box, but shit, human feces. Is the kind of the dishonesty, right? I would be fine with it, honestly, if it was presented as like, hey, this thing barely works. Gas fees are crazy most of the time, and there's hacks all the time. Like all sorts of like crazy Ponzi schemes get implemented on this, and it's a speculative pump and dump platform. I would actually be okay with that if it was like, yeah, you got Bitcoin. And then you got what we're doing over here. We're trying to make money here. We're trying to scam people. We're trying to do our thing. But it's never presented that way, right? And none of this stuff is. It's always the classic affinity scam. I love Bitcoin, buy my shitcoin. And that is never more prevalent than in the bear market. We see everyone who has been pumping, Luna, Terra, all this fucking bullshit, they're suddenly Bitcoin maximalists. They're suddenly, there's all these tweets because that is what gets the most engagement, right? When you have fucked over all your subscribers and all the people you've been shilling this like bullshit Ponzi token to, excuse me. The most effective strategy, the easiest strategy at least, is to say like, oh my gosh, I didn't know, who could possibly have foreseen this outcome? And all of us are like, motherfucker, like we've been screaming about this for literally years. Like, all we have been doing is screaming about how Bitcoin is a completely separate thing. It is an innovation, and everything else is basically just trying to affinity scam that shit. But nobody says that when there's the possibility of making money, and it's really, really frustrating. All this shit is basically just, as we talked about ad nauseum now, a reimplementation of the current or previous VC-backed system in terms of like startups and that style of financing, where the thing that you care about is time to liquidity. So, how quickly you can put money in and then have it 2x or 5x or 10x or 50, whatever it is, and then exit. And that's really all these people care about. And the promises are just absolutely nuts. And we could talk about this for hours, but what are your thoughts? Q, Chris?
I guess I'll start. I say the banks are a 2 of 3 multi-sig in the fiat world. So, if you're in good standing with the government and the bank, then, you and the bank or you and the government can agree to take money out. If you're not in good standing with one of those two other entities besides yourself, you can't get your money out. And that's a quote that I stole from someone else. I forget who said it, but I thought it was very, very clever. You look at this through history too. If you are Japanese in the 30s, it's very difficult, what the atrocities we did in the United States. If you're Korean in the 50s, if you're Vietnamese in the 70s, if you're Muslim in the 2000s, early 2000s, or Middle Eastern, still now, if you're Russian or a Canadian trucker, you're on the shit list of governments. So, it's a 2 or 3 multi-sig, and it's only a matter of time before your day is up for when you're on the shit list of you're not allowed to take your money out. You're not allowed to do it for whatever reason, whether it's just or unjust. They can prevent you from moving your money around. Go ahead, P. You want to riff on that?
I would love to, but Q, I want to give you the opportunity since I've been talking for a while.
I mean, I said at the start, like, this is all just DeFi in name. It's a more apt name for a lot of these things would just be like
It's CeFi.
refi, re-centralized finance. Because it recreates this system, but in a different way. Like, the old prank when you would take a brown paper bag, put dog shit in it, light it on fire, and then like you ring someone's door. Like, did none of you guys watch Billy Madison?
Who would do that? I have never done that, nor have I ever heard of such a horrible thing.
I've seen it on Billy Madison, but I've never done it.
Do not answer the doorbell later today, P. But like the whole point is, someone freaks out, you see this fire, so you step on it, and then inevitably you've stepped in shit. Like that is
Thank
DeFi.
you for explaining the doorbell ditch.
No, but that is DeFi. That is DeFi. It's a knock on the door with a promise of, hey, there's something really exciting here. And then you open it and like, oh shit, there's a fire. I gotta throw a bunch of money at this right now. I gotta, let me keep on buying on the dip. Oh, Richard Hart keeps telling me it's gonna go up. Oh, fuck Bitcoin. Oh. And then all of a sudden, when the dust settles, your shoe's just covered in shit and you lost all your money.
And Richard Hart has all your Bitcoin.
And Richard Hart is going buying a fucking...
The video of him twerking is all you need to see in like some Gucci tracksuit. It's like, yep, that's where your Bitcoin went. Went into that Gucci tracksuit and his fat fucking ass. Good job. Yeah.
I want to iterate on that. When did, I'd say in this bull wave, it's all been about the lending platforms, the DeFi, exactly what Q hit up on. I'd say not the Bitcoin maxis, but like it went from, proof of keys, what is proof of keys day is January 3rd or January 8th. I forget what day it is. Trace Mayer was like, prove that these exchanges aren't rehypothecating your Bitcoin by withdrawing. It's one day a year. I believe it's the 8th that you always do that. Or it kind of became a trend after the Mount Gox, basically. But we went from that to, give your Bitcoin, or at least, the industry went from give your Bitcoin to this exchange or entity so they can rehypothecate and do dangerous things with your Bitcoin. So it's just very funny how these scams go change the narrative. And what was American Hodl saying? Like the next one's going to be not NFTs
identity,
were kind of this wave. What?
Yeah, he thinks the next scam is going to be based on decentralized identity systems. So there are real decentralized identity systems on Bitcoin, but his belief is that there's going to be
pronoun coins.
I'm only going to bring this up, and I didn't bring it up yesterday and I still haven't really like read deeper into this, but I could have sworn someone on our company Slack channel like posted that like 30 minutes before American Hodl like said it to us, and I don't know. I had a moment where I genuinely thought I was still dreaming because I was like, this is all just very fucking weird right now.
Yeah, I mean, it's pretty wild. But to just reiterate on what you just said, Chris, yeah, I mean, I've been screaming at people that trying to get yield on Bitcoin, that's to say trying to get yield on the most important asset that has ever existed by giving it to somebody else is a fiat, mindset. It is the kind of definition of high time preference. And when we say high time preference, this is a term that I don't believe was coined by Saifedean, but it was made popular by him in his book, The Fiat or the Bitcoin Standard. The idea that basically you have low time preference activities or decisions, which are those that are focused on the future and building systems that have a long timeline in your own life, versus high time preference, which is basically like, I'm going to smoke a cigarette, I'm going to get super drunk, I'm going to fuck my life up. And a lot of the way that we are forced, if not very, very strongly encouraged to behave by our government and by kind of the society that we all participate in, right? It's easy to kind of otherize a lot of this shit, but I mean, shit, I binge TV as much as anyone else, right? That is a high time preference behavior. When I stay up super late at night, when I'm like, oh fuck, I should go to bed because I'm going to function way better tomorrow if I get that 7 hours sleep. That's, high time preference behavior. That's me in the moment being like, I don't even like this show, but I don't want to go to bed yet, right? So we all like, one of the things that is so interesting about Bitcoin is that it encourages low time preference behavior. That is to say, behavior that serves our future selves more. And that's kind of an alien thing in our modern society and culture. And you just, in our private chat, just said, I just did everything
Unmute me.
last night.
Unmute me. Am I muted still?
No, you're good. You're good.
I literally smoked a cigarette, was going to go to bed at a reasonable time. And then literally my girlfriend was, she was like, I need to go to bed. Like, I have to wake up at 5 tomorrow for work. I was like, I'm going to wake up with you. Don't worry. But I'm going to watch the episode of Obi-Wan from last week, which I haven't watched yet. So
it's better than I am. I'm terrible, man. Like, for some reason, when it like hits like demon time, or I guess demon time is technically like 3 a.m. or something, but like when it's like late at night, right? When it's late at night, man, I just like, oh God, I have to really fight myself in order to not just like become a high time preference bitch and just watch bad TV. And like, why do I do it? Why? Anyway, the point is,
what's
Bitcoin
the go-to
encourages low
bad
time
TV
preference
show?
behavior.
What's the guilty pleasure show?
Oh, what's mine?
Yeah.
Oh, what have I watched lately? Oh God, I watched the worst fucking movie. Like, I'm so embarrassed to even.
Is it The Room?
No, The Room is amazing. The Room is a terrible movie, but it like transcends terrible.
You would
so
actually think that movie is amazing and has a place in cinematic history.
No, fuck that. It does not have a place in cinematic history. It's just like a train wreck that you watch happening, much like Celsius right now, where it's just hard to take your eyes away from it. I actually had heard about The Room and like was forced to watch it by a coworker of mine before like the modern resurgence of it. Cause it was, I mean, you know this, you live in LA, like it was a huge thing. And I had a friend who lived in LA. He's like, yo, you got to watch this movie. And I was like, why are we watching this? This is just like a bad porn with no sex. And then he like explained the whole thing. And anyway, I find it fascinating. The point is, it's all bullshit. We all have to be better about using our time, investing in ourselves, our families, our futures, and Bitcoin encourages that. And the DeFi, what I would call CeFi, centralized finance systems that pretend to be DeFi, right? They make the claim that it's decentralized. They are all just systems that are designed to take Bitcoin out of your pocket and then insert it directly into the pocket of the people that created that token. And we see this. The most pronounced example of this is with Celsius and everything that's happening with Celsius right now. They had a Celsius token, which was literally created to create more liquidity, more exit liquidity for Alex Machinsky and the people on that platform. He and I had a very public argument about this over a year ago on Clubhouse, where he just kept repeating like, do you want more? Do you want more or less? And I was like, no, I want, if I were to use Celsius, I would want my money to be stored safely, securely, in a way that did not put everything that I care about at risk. And it was just, do you want more or less? And that's like the classic fiat mindset, which is just how can we incentivize people to do things that are bad for them in order to line our own pockets? I was in a room last night, and then I'm going to stop talking because I want to hear what you guys think. I was in a room a space on Twitter that was people that had been fucked by Celsius trying to cope with the reality. And I went in intending to like get up on the stage and, really kind of just like be like, hey, look, this is a terrible thing that has happened to you. I hope that, you know, we can help sort of explain why this happened and why you shouldn't be doing this anymore. And there was like a Celsius bro in there who was like, yeah, it's all gonna be good. It's all gonna be good. They're just freezing accounts so that we can set everything up, get it real strong again. And then they're gonna open withdrawals. That is never going to happen. They're never gonna open withdrawals. You're totally fucked if you had money on Celsius. I'm so sorry. The point is, I actually it was so sad. It was so demoralizing to hear these like genuine people who like had put their life savings into Celsius try to cope so hard and tell these just inane stories about how like, I met Machinsky once and he looked me in the eye and he said I could trust him. And so I trust him. It was just super depressing. I ended up just being like, oh fuck, man. Like, just, I hope you learn one day. They wouldn't let me up on the stage, but it was really sad. And if you're in that situation, I would encourage you, don't just take the easy path and put effort into believing the fantasy. Take responsibility for this being a hard learning lesson and move forward. And I would encourage you to look into Bitcoin because it's the best shit ever.
Yeah. And I guess going with the low time preference stuff, like P, I think everything you said was excellent. And I know even Corey was saying that he's met Mashinsky before, and not to slander, but he said he's like, don't trust verify. And even just meeting the guy, he did not trust them. I know that hindsight's 2020, but to show people, like, the Celsius token came out in 2017. I had to look this up myself. And so for 5 years, Bitcoiners were kind of like, hey guys, like this Celsius thing, you shouldn't be in it. It's not good. They don't need a token to do what they do. And they're like, no, dude, it's been around for 4.5 years. And they were still good, 6 months ago. We're now at the mark 5 years, which is kind of a long time in the cryptocurrency landscape. You think if Bitcoin's only been around 13 years, so this Celsius token's been around 5. But it finally imploded. And people are like, man, it was good for 5 years. Like, what do you mean? You didn't warn me. Like, it seemed fine for 5 years. It's like, we were telling you for 5 years, this would take time to develop, but it eventually would implode. And that's exactly what happened. I don't want to rub it in people's faces, but it's just like when you go on to the next crypto scam or whatever, NFT or whatever it may be, like, they're like, I'm making money here and now. And I guess in the last 2 years, basically, you could have made money in anything you've thrown. I guess maybe not the last 7 months or so. But prior to that, the last year and a half before that, you could have thrown your money into basically anything. There's a great clip from CNBC Fast Money. And it's like, he's like a hedge fund guy. He's like, I bought this stock and this stock and this stock. They're like, yeah, what's this stock do? And he was literally like, I can't hear you. They're static. And he literally like hangs up, and people were making fun of him as he's like, I've got a Lamborghini. I don't need to know what they do. But like literally the guy is investing people's money, other people's money, and had no idea what this company did. Like, that's like just as degenerate being like on Robinhood, opening up the app and just being like, I'm going to buy whatever I see is lighting up green, but not knowing anything about the company or anything. Sorry, that was my rant. But yeah, I think Bitcoiners give that low time preference of like, you say that it doesn't blow up now, but when it blows up, it could have been 5 years, 2 years, however long it may be. And like, you need to look at it like that. Like, that's the risk you're putting with giving your money to all these altcoins, basically. Go ahead, Q.
I actually think, while I agree with everything you guys have said, I don't agree with it in the scope of what we're trying to accomplish, which I actually think the biggest reason why so many people get duped and go down these paths and think like, oh, like I can make more money. It's a lack of understanding of how money should be created, not how money is created, because unfortunately we, for our entire lifetime, except for Grandpa P, have only ever seen the US dollar in a free, pure fiat, no gold backed system. And it had a very low cost to create capital. And as a result, we are bearing witness to see what happens when it costs next to nothing to make money. But historically speaking, there has been a cost to create capital, and that is, limited the supply that you're able to introduce into the market. And so when you start to understand that the price of gold is not only its value that it has in the open market, but also part of the cost of gold is how much it costs to mine and clean and ship and get it to you. And the same is true for Bitcoin. There is a cost for Bitcoin miners to mine their Bitcoin, and that is inherently baked into the price of Bitcoin. However, there has been a discussion, I believe it was on last week's Blockware Solutions newsletter where they discussed there is a certain point that we are approaching very, very close or very soon on the downside where this would actually have the price of Bitcoin be below the cost it takes for a miner to create Bitcoin. So that is a full-blown possibility, and things can get really messy if that does happen. I think a lot of miners are going to have to reevaluate their business model in the short and long term. And I think those that have a heavier stack are going to be able to ride out that winter, and they're going to be able to, take losses for longer until the next bull market. And then the next bull market, they probably are going to have to reevaluate what they did on the last bull market because it led to them in a bear market having to maybe dipping into savings is part of the plan. I don't know. If I knew, I wouldn't be here. I'd be running a publicly traded mining company akin to Riot or Marathon. But that's to say, it's this lack of understanding of what is money and how money is created and how good sound money should be created. Because if you have those understandings, if some snake oil salesman's like, yeah, but like, I can give you more money. Like, give me some of your money and I'll give you more of it back. Like, that's literally the fucking playbook of all of these scammers. Oh, hey, can you send me 1 Bitcoin? I'll send you 2. Like, Mashinsky just did it with different words and in public. I don't know if I respect him more or less for that.
Less. You should respect him less. Yeah, I mean, one thing I would say is, we talked about this recently, but having said everything I just said, right, and fuck everything that Celsius did, we need to acknowledge, rather than demonizing individuals, which is appropriate many times, we have to look at the systems and the incentive structures that are in place. And, I would be shocked if Mashinsky looked in the mirror every morning and was like, I am a demon who is stealing people's money. Like, yes, he thinks of himself as a good dude. And, he uses the same justifications for his behavior as the people that we were just talking about who are like, it's been around for 5 years. And I think like that is incredibly irresponsible, but I think that we need to fix the systems and the incentive structures that are in place rather than, or in addition to, demonizing people who take advantage of others. The last thing I'll say is, I think it is easy to, well, it's not easy. I want to encourage people who are Bitcoiners to help educate, like, fuck the people that are perpetrating this stuff, but people that are like trying to cope really hard with these like massive, sometimes like life changing losses. I think that we as Bitcoiners, even when people are saying stuff that's frankly ridiculous and insane in order to try to like cope, I think that it's an opportunity for us to try to explain to them like why Bitcoin is good rather than like screaming at them. I say this as someone who loves to go into rooms and be like, yo, fuck you, fuck you, fuck you, but, and I think that is an appropriate response to people that are legitimately in those places trying to scam people actively. But I think the people who are victims of this can be brought into Bitcoin, with more empathy. Sometimes, maybe. I tell myself this after I go into a room and scream at everybody.
I agree that we should educate more people. This is the last thing. We're going to cut to commercial. I don't want to make our guest, Nik, is waiting for us. And honestly, he probably has a lot better things to say about
he definitely
just
does.
The fiat system. I'm fully on board with shaming scammers and calling scammers out where they are. That I actually think we should continue to do. But on that note, let's cut to a quick commercial break, and we're going to be joined by today's guest, Nik Bhatia.
Hit it.
Boom. That was awesome. I loved that. Welcome back, guys. Thank you for sticking with us through that commercial break. I'm really excited to announce friend of the show. We've had him on once before. He's the author of Layered Money and an adjunct professor over at USC, Nik Bhatia. Nik, thank you so much for joining us today.
Q, great to see you, man. Great to be back. And those drums had me. That was
I was dancing.
Right?
Yeah, I love that.
Shout out Bilal over in, I believe he's in Turkey. We, reached out to him, and thank you to all the Bitcoiners who helped coordinate that. I believe that wallet address is available and working now. So if you feel inclined, feel free to shoot him over some sats as well. But he's an awesome person. We're grateful that he took the time to make that video for us.
And to be clear, there was a QR code that was up in the upper left-hand side of that video while he was singing. You can just jump back later, send him some sats.
Yeah, don't leave this conversation, because this is one that I'm really excited about. Nik, you have been on a tear with the Bitcoin Layered newsletter that you guys have been putting out. There's a lot going on in the world. You guys have been, keeping everyone up to date on both what's happened, the effects it's happening on day-to-day life right now, and what your expectations are going forward. We can start at a lot of places. I would like to start first off with the Fed. You actually were the one to tip me off to this, but the Atlanta Fed, and Chris, if you could pull up that chart from the Atlanta Fed from yesterday, they announced that their GDP forecast for Q2 is now forecasted to be 0. So not necessarily negative, which a negative reading for Q2 would put us into a recession, but talk to us about the significance of this forecast coming in at 0 right now, we're now 9 days out from the quarter ending.
Sure. Well, the difference between slightly positive 0 and slightly negative is not important here. What's important is that GDP is slowing down materially in the United States, and we are bordering on a technical recession, which is also not that important. Technical recession is 2 quarters of negative GDP growth, which if this print ends up being negative for Q2, that would put us in technical recession. What's more important than any of that stuff is the end of the business cycle and going into a contractionary environment in which credit is tightening, borrowing decreases, spending decreases, employment decreases, and asset prices respond accordingly. And so what we've seen over the last quarter to 2 quarters is a significant drawdown in risk assets. That has been pricing in a recession. Now the economic data is finally starting to tell us that recession is here, just about, technically or definitely here. Again, that doesn't really matter, but what does matter is that the signal that we're taking that we are at the end of the cycle. And mind you, at the Bitcoin layer, we've been writing about yield curve inversion since October of last year, and how yield curve inversions are a leading indicator of recession. And it's actually going to be the subject of my second YouTube video, which is going to be out on Thursday. Yield curve inversions are a sign that recession is coming at some point in the future, because the Fed is hiking rates to slow down the economic cycle, or to send it into its grave, basically, because inflation is going up. And we've seen that from the yield curve over, half a year. And here we are now at a technical recession.
And I just want to sort of clarify for the audience, and I say this as someone who knows, or I would say you have forgotten more than I know about all of this stuff. So, but my understanding when we talk about yield curve inversion, and please correct me where I'm wrong, is that, if someone came to me and was like, hey, can I borrow $100? I would probably want to know, like, oh, that $100 is valuable to me as cash. So sure, but there's going to be like a premium on that. I'm going to need like some kind of interest on that. So if, normally if I asked you like, well, how long do you want to borrow it for? And you said 10 years, I'd be like, all right, let's say, and I'm pulling this out of my ass, but like, let's say I want a 10% interest on that over the period of 10 years. So I want to make an additional 10%. Normally we would expect that if I asked you that same question and you said 1 year, that I would give you a lower interest rate. I'd say, well, since that $100 is only going to be locked up for 1 year versus 10 years, instead of 10%, I only need 1% interest. And if I understand correctly, yield curve inversion is where we actually see the inverse. So people want to make loans where they are getting the shorter expiration loans are actually higher value. We see higher interest rates on those 1 year, or in this, I think the common one is a 10-year over the 3-year, right?
10-year and 2-year is the one
10 year
that
and 2 year.
is commonly cited. Yes. And so you have that correct. That's what a positively sloped yield curve is, the natural shape, which is what you were describing in the first part of the example. And an inverted yield curve would be, the opposite of that. Now, what you're describing is a consumer lending type of environment, or even a corporate lending type of environment. But this yield curve inversion that we're talking about is in the US Treasury market, and it's also in other parts of the interest rate derivatives market, that is largely based off of the US Treasury market. And the plumbing of the financial system and an inversion there, it's quite different than if we had a consumer facing yield curve inversion, or even a yield conversion, a yield curve inversion that would benefit the consumer. Someone that borrows at 2 years and has to pay 10% versus someone that only has to pay 2% if they borrowed for 10 years would be highly advantageous to a consumer. But that's not really what we're talking about here. So you have the example right, but the target market is not, the same thing. And so in the treasury market, the behavior of investors that buy and sell 2-year treasuries has its own entire fundamental dynamic that has to do with the entire world economy, the world's financial system, central banking, asset management, forex management, cash management, all these enormous fields that impact 2-year treasury yields. And then in the 10-year part of the curve as well, we have this entirely, honestly, an enormous universe of actors that play in that market to buy and sell 10-year US treasuries. And some of it being the same as the 2s, but some of it being different in that the 10-year part of the US Treasury curve is considered the risk-off asset for basically all of asset management. And we can call that probably somewhere between $1 and $300 trillion of size of market for the 10-year part of the curve. So when we look at the difference between 2-year US Treasury yields and 10-year US Treasury yields, we're talking about two parts of the monetary system and financial system that really have their own dynamics. And so to tie it all in, when 2s 10s is inverted, which right now it's essentially flat, it's essentially zero. It's inverted a little bit over the last few months here and there, but we're at a flat level. What the market is saying is that we expect the Fed to be raising rates very quickly, but the overall growth and inflation level of the US economy over a 10-year time horizon is unchanged relative to that increase in short-term interest rates. It's not making it so that the investors believe that all of this hiking and raising of interest rates is going to turn into long-term inflation, or that long-term inflation is actually something that the market believes. It actually doesn't believe that, and that's expressed with a flat yield curve. The market does not believe that we're headed to 5 to 8% inflation. Otherwise, 10-year yields would be at 5 to 8%. They're not. They're still at 3.25%, just where 2-year yields are. And 2-year yields are at 3.25% because that's where the market believes the Fed is eventually going to hike rates towards. Right now, we're at 1.75%.
What, in your experience of watching the Fed play with these rate hikes, especially in the post 2007 2008 financial crisis time period, it seems as though the market either knows or almost tells the Fed what to be doing. Even the most recent rate hike of 75 basis point, the market shifted its tune by Monday after the inflation reading it got on Friday, and the expectation was settled that, hey, we're going to get 75 basis point hike. But in the days of Volcker, when he's going up 250 basis points, this was not pre-forecast by the market. This was not understood ahead of time. What effect are you seeing that have on just the general markets?
So we have a saying at the Bitcoin layer. It's that the Fed is a slave to the rates market. The rates market moves first and prices in what the Fed is going to do so that when the Fed acts, it's not disrupting the market. It's not making people lose money overnight. They have at with the most recent rate hike, it was fascinating to watch. The Fed only gave the market a day and a half to digest the news that it was going to hike 75 basis points. It leaked the hike through the Wall Street Journal that it wasn't going to go 50, it was going to go 75. The market adjusted really quickly just in time for the Wednesday meeting. But generally, the Fed doesn't want to upset the market. It wants to tell the market in advance what it's going to do, get the market there, and then when it acts, it doesn't disrupt the market. So we historically have seen that we can trust that the Fed will do what it's going to say it's going to do with some sort of a 3 to 6 month time horizon. But it can change really quickly. The Fed can say something, it's going to do something 3 months later, and, basically 4 months later, everything has gone to shit and the Fed has to pivot. That can happen. It can happen quickly, but it doesn't usually happen within 3 months. So that's what the Fed is trying to do. They're always trying to lead the market. The rates market gets there. But then at some point, we will see the 2-year yield come crashing back down. And that's the market telling the Fed it has to stop hiking rates. And the twos will come crashing down toward where the Fed funds currently is at that point or below it. And then eventually the Fed, within days or weeks, will have to say, we're pausing our hiking cycle, and it'll be basically responding to what the market is telling them.
Nick, I always love when you really break these things down, because I don't think many of us really understand the nuances of how market participants really think and view these yield curves. Um, we hear stagflation get thrown around a lot. You brought up and highlighted in one of the most recent issues of the Bitcoin layer that unemployment is reaching these historic low levels. And it almost implies there's this nice little, I'm going to steal yours and Joe's words here, a nice little hole to thread the needle through, where you can let unemployment go up for a little bit, but not too much. I'm going to just ask a very direct question here. How confident are you in the Fed's ability to actually maneuver this? And if they're not able to properly maneuver this, what are your expectations?
Yeah, so the Fed, what we said, and I just want to, pause for a second to acknowledge that at the Bitcoin layer, we've gone from 1 to 3 people, and the explosion just in energy and amount of content that we've been able to put out. And, we launched the YouTube channel today. There's so much more to come. And I'm so thankful that I'm not just by myself anymore. So special shout out to Joe Consorti and Matthew Ball. Joe is helping with research and growth at the Bitcoin layer, and Matt is helping us with our design, our content strategy, our videos, and our graphics. So I'm very thankful to have now a team of 3. Previously, it's just me and my wife. I'm writing, and she's helping me look at things and give me feedback. And now we are, we're going into a proper business mode here at the Bitcoin layer. So I hope everyone subscribes to Substack, the YouTube, and joins us for the ride. There's plenty of free educational, and research and analytical content that we're providing. So with that being said, back to your question about unemployment. There's only one thing here. It's the cycle. And so the cycle drives all. And at the end of a cycle, when you're going to recession, right before you have inflation that's heating up, and this is generally speaking, and that's not even to mention the especially inflationary episode that we're having right now with inflation at 40 years high. But generally in the cycle, inflation is at its highs at the end of the cycle. The Fed is tightening monetary policy in response to that. And the reason that they're tightening is so they can bring inflation down. How do they bring inflation down? They slow the economy. What happens in a slowing economy? Unemployment goes up. So they say they want to thread the needle, but it's irrelevant. What they're doing is going to drive the recessionary or contractionary environment. Say we don't even get a recession. We could just get this growth shock where growth stops at zero. And even then, we'll have a spike in unemployment, whether it's a little bit or a lot. The unemployment goes up. So they can say they want to thread the needle, or they only want to bump unemployment from 3.6 to 4%. But we should never take the Fed's economic projections at their face value. They're terrible at projecting 1 to 2 years out. The only thing they're good at is saying what they're going to do over the next 3 to 6 months from a monetary policy perspective, because that's their only job, is to come to a meeting every 6 to 8 weeks and say raise rates, lower rates, QE, QT, whatever. That's all that they're good at. And they're not even, good isn't its own word. We won't get down that path. But that's all that they do. They conduct monetary policy. They're terrible at economic projections. They completely missed inflation. And we just can't trust whatever they're saying. So the only thing that people need to understand is that the cycle is what matters. Where at the end of the cycle, and at the end of the cycle, Fed tightens, inflation and growth go down, and employment goes up. So right now, that's why the market does believe we're at peak inflation, even though we could get inflation to 9%, and we could even get it to 10%, and it could last for another 6 to 12 months. I don't necessarily believe that's the path. I think that it'll slow a little bit quicker than that. But the point is that it'll roll over because the Fed has tightened already. The market has tightened for them. We know this because 30-year mortgage rates are at 6% now. That's not because the Fed funds rate is at 6%. Fed funds rate has gone from 1/4 to 1 3/4. But mortgage rates have gone from 3 to 6. That is a real tightening. So forget that. Fed doesn't matter anymore. The market has tightened. The real estate market will slow. That will have an effect on the U.S. economy. The U.S. economy will slow. Unemployment will increase. That's what I'm trying to deliver to our subscribers and to our viewers, is a simple way to understand where is the economy, what is going to happen. Stop listening to the Fed's projections. Look at the market. Look at some economic indicators that are reliable, that tell us where we are in the cycle, and understand what the cycle does to investment returns.
Nik, you brought up housing, and I do want to touch on, in the part 1 of your recession, Bitcoin's first major recession blog posts, there is a chart of the 30-year fixed mortgage rate, and something that you guys highlight, which I found very, very troubling for myself as someone who is trying to look to buy a house, is these mortgage rates are now above levels during the 2008, 2009 window when, shit really hit the fan. Looking at this with what the Fed has been saying, let's talk first housing now. for a little bit. Expectations for the housing market. This seems to be the one marketplace that hasn't seen the drawdowns that the public equity markets or even the broader cryptocurrency markets, or more specifically Bitcoin, have seen over the last few months.
Yes, this is a very important chart. It directly affects affordability. It's the direct consequence of the Fed indicating it's in a tightening cycle, right? So the market responds before the rates market responds before the Fed does. But the rates market forces the Fed's hand because the market is conducting monetary policy really for the Fed. And so what happens here is that we see inflation skyrocket. The market understands the Fed will have to tighten. Short-term rates and long-term rates go up, and then mortgage rates go up because they're linked to these treasury yields and other interest rates in the market that are pricing in an increasing Fed funds rate over the coming 24 months. And that's what happens. Everything becomes more expensive. And the main feature of that is the borrowing cost. So the borrowing cost is skyrocketing. That's what the chart is telling you. And if the borrowing cost skyrockets, people cannot afford to do the same things that they were doing. So I'm not trying to make nitty-gritty housing projections that the real estate prices will come down across the nation, or that we'll have a collapse in new home sales or permits or anything like that. Again, what matters is the cycle. We are going to slow. Housing is going to slow because of all of this stuff. When housing slows, we have a wealth effect. The wealth effect is this idea that when the stock market and the real estate market increase in value, Americans feel wealthier because they can use the increased home price to take out equity. They feel wealthier because their 401k is higher, and they believe that their retirement can come sooner because of that retirement income that they have, and they spend more. That's the wealth effect. So the opposite is true. When your home price comes down and your stock market portfolio comes down in price, you spend less. The consumer is 70+% of the US economy. Economy slows. Companies look at that slowing economy and they say, we're not going to hire at the same pace, or we're going to lay people off. We have already seen that in the headlines where we see layoffs. So it's all cycle driven, and it's all actually predictable at the margin what's going to happen to each one of these components when you know where we are in the cycle. And right now we're at end cycle.
This may be a conversation, a deeper conversation, more philosophical, but I'm paying a lot of attention to private equity firms that have started to enter not just the housing market, because they've always been in some way affiliated with the housing market, but now going out, buying, owning, and essentially being landlords on single family homes. To me, this feels and reads like a very dangerous practice that inevitably just leads to corporations owning all of the land. They seem to have an endless supply of money that, in my opinion, has been one of the root causes of an increased valuation of homes, because not only are individuals bidding against other individuals, but now you're also bidding against BlackRock. And other than the US government, I don't think anyone else has more money than BlackRock. Do you think these private equity firms that have entered the single family housing market could almost artificially keep the housing market at these levels for an extended period of time? Or is that just, are they going to feel the effects of a rising interest rate no different than individuals would?
It's a fair thesis that we have a segment of the demand today that we didn't always have. So I would say it's a fair thesis to think that there would be marginal support during this cycle downturn that we wouldn't have elsewhere. But in the end, the price and the yield on the asset is going to be what matters most to a BlackRock. And so if they look at the price and they look at the rental yield and the number doesn't make sense, they will offload the asset in search of better yield elsewhere or other better risk-adjusted returns. So, that would be the way that I would think about BlackRock in the market.
I could accept that.
And I didn't really answer your question about the interest rate component of it, but the interest rate component will lead the price to adjust, and it'll also lead the relative value of the rental income yield to other assets. So the interest rate filters down into the two other metrics that BlackRock is going to look at, which is the price and the yield on the asset, and they'll compare it to interest rates elsewhere. And so the market will shake out where it shakes out, and we'll see if private equity is a lasting force in the market, or if consumers are better able to withstand the interest costs associated with this most recent tightening.
As much as I'd love to see the downturn, and many of us would, of a company like BlackRock, I think all of us are more concerned with our own individual well-beings. I'm gonna keep going down these charts, and I lost P. So it's just you and me, Nick, and I get to have a very fun, okay. Consumer credit. This is the one that I am genuinely concerned about, and this feels like this is our version of the 2008 bubble. Walk us through first, like, what does consumer credit even measure? And then what are you seeing in these charts?
Yes. So when we think about the consumer and we think about sentiment, that is also another indicator of where we are in the cycle and where spending is going to be. Because remember that the consumer is about 3/4 of our economy. And so if spending goes down, then the whole economy slows. So when consumer credit is being exhausted and we see a spike in borrowing toward the end of a cycle, what it's telling us is that the consumer doesn't have cash. They need to borrow, and they're using all of their borrowing capacity right now at the whatever rate that they can get, because they're fearing that they won't get that next extension of credit. And that's usually preceding default waves. So again, another cyclical component to the economy is that at the end of a cycle, going into a recession, or the mark of the end of a cycle is defaults start to happen because people don't get the next gig. They are getting laid off and they're not able to roll the debt. Also, interest rates are increasing, so they're not able to afford the higher reset of borrow, or the latest interest rate, or the next credit card offer comes in at a rate that's much higher than what they could afford, and they were rolling over on 3 previous credit cards as rates ratcheted up. And the consumer basically ran out of gas. So it's another way to think about cyclicality, and we can look, back at 2007 and see a similar pattern.
Sorry, I couldn't find the unmute button. We're, as you mentioned, we're seeing almost this repeated cycle or pattern. Is there a specific area of spending that you are seeing is heightened, or maybe it's just the general inflation woes impacting this consumer credit bubble as well?
Yes. So we also have to keep in mind that PMIs and survey data in the United States are still materially above 50, which means we are still in expansion. That's why I say technical recession, because we are headed for this technical recession, but really things are still buzzing. Corporate profitability is modestly there. It's not screaming recession necessarily. And so we have some recession indicators, but other parts of the economy saying that the economy is still hanging on. And, with that, I think there's an important dynamic there that we can watch. I don't like to watch too many sub indices or 1,000 different economic indicators. I choose 5 or 6 of them. We are going to do a video about it on the Bitcoin Layers YouTube channel, probably by next week, to show, we just have to look at ISM data, PMI data, consumer sentiment from University of Michigan, small business optimism, only a few things to tell us where we are in the cycle, and then predicting the magnitude of the cycle each way and predicting the moves in markets each way. I think it's beyond what I want to try to do for the reader and viewer, because I don't think there's a ton of value in saying that we're heading to a deep recession or a shallow recession. I don't think that matters. What matters to me is explaining the cycle. Explaining that risk markets will sell off 6 to 12 to 18 months before a recession, and that you'll see the best returns basically once the recession has been, at the on the headlines of every newspaper around the country that we're in recession. So those types of takeaways, that's what I'm passionate about. That's what I'm trying to build with the Bitcoin layer. I want it to be unique and not just something where we're making calls every day and we're not a hedge fund. We're not a trading service. We're a research and educational platform. So I want to always balance what I'm saying without making these numerical predictions, but rather guide the readers and the viewers through understanding the economic cycle and what that does to the rest of the investment world and how it impacts Bitcoin, really.
Has there been an example historically where some of these economic indicators are suggesting we're in a technical recession while the broader economy seems to flourish?
Maybe not flourish, but there's the correlation is close to 1, but the magnitude and the level in terms of expansion or contraction is not always on point. So the direction is kind of always right, but not necessarily the level. And so, yes, you'll see examples in the past of, GDP being slightly negative, but other economic indicators are slightly positive. But what we're not able to avoid is this direction.
P, I don't know if you were just going and making doomsday preparations or not. I now get to ask my favorite question that I have frankly held back on asking for so long.
Hit us with it.
Correlation.
Oh, shit.
So you guys highlighted in part 2 of the major recession, Chris, this would be the NASDAQ 100 chart with the orange Fed. I want the orange Fed rate below. I want to start there because we're seeing, and you guys really highlighted an excellent point here, where it seems as though the growth we saw in the stock market almost perfectly coincides with the fact that we had a Fed fund rate of practically 0. And now as we slowly see this incremental, no, not this one. Just a blue and orange line. Sorry, here.
The orange line will be the one with the step function upward. That's
yeah. I'd love for you to just sort of break this down a little bit and talk to us. Yeah, that's the one. Of when you look at this, what you see, because when I look at this, I see, we were purely in a bull market because we kept the rates at 0. And as we're increasing it, we've jolted the market and we're starting to see the effects of what a real economy, unfortunately, would look like in the stock market.
Q, can we set the record for the number of times that one person says the word cycle in a Bitcoin podcast in under 90 minutes? Can we go for the record?
That's awesome.
I believe the record was 98 times. So we are at, I believe, 16. So we have a little bit to go, but I'll throw cycle.
Okay. So that's 3 more, and I'll give you a few more here. This picture is a perfect example of what a short cycle looks like in incompletion. Okay, so start at the left of the chart. What we have is the end of an economic cycle that was right before COVID. Then you had a COVID crash, and you had the Fed funds rate come basically all the way down to zero, as what happens is the Fed has to cut when you're going into a recession. And that's also key, to bring it back to where we are in the cycle. The Fed is still in the hiking portion of the cycle, not even close to the cutting portion of the cycle, which probably, let's say, comes next year. Okay. So what you have at the beginning here is the Fed cutting. And when rates go down to zero, that's the end of the recession. Okay. From, if you wanted to date it, it would be the day that rates got down to zero. The stock market bottoms on that day and then has a massive run up for the next year and a half, 2 years, as rates are at zero. But then what do you see? At the end of 2021, inflation is starting to rage, and the Fed basically has to admit that we're going to start hiking rates. They didn't do it till March, but look what already happened. The second they acknowledged we have to hike rates, risk markets sold off as you are turning in the cycle. So the economic cycle is going to turn 6 to 12 months after the stock market peaks. 6, 12, 18 months, doesn't matter. That is that peak that we saw of late last year. That's the signal that the cycle is over. We only know looking back. That's why, again, I'm not a trading service here. We have to look back and analyze. What does that mean? It means that the peak that we saw end of 21 was the 6 to 12 month indicator that we're at end cycle. Does the end cycle mean a quick growth shock, a brief contraction, or a deep recession? No idea. We won't know until more data comes out, until we see how deep the stock market goes. NASDAQ is down 33%. If it goes down 60%, deep recession. If the bottom was, last week at 33%, maybe just a shallow contraction. Again, it's about identifying the cycle. And then, so right now when the orange line's going back up, the Fed is saying, we're going to stop the cycle too. We're here to stop the cycle also. Even though rates markets are, and equity markets and the Bitcoin market, interestingly enough, is doing all the work for them. As portfolios go down, you think the wealth effect applies to Bitcoiners? Hell yeah, it does. We eating steak tonight, boys memes when we are at 70K is the same thing as we're going to McDonald's today because we're down 50, it's the same thing. It's the wealth effect of Bitcoiners. It's a fraction of I'm not saying that actually impacts top line GDP growth in a material way, but it's the same behavioral effect that we get. The risk market sold off. Economy will slow off of the back of wealth effect going back 6 months. Then interest rates go up. Housing slows. The Fed is hiking into all of this as it admits it's behind the curve. And we know that they're a slave to rates market. So they're irrelevant from some of that signaling perspective. The rates market leads by many months, but tightening is here. So what you're looking at there is a short cycle. It's a short cycle because of the pandemic and the response and the fiscal response, the monetary response. All of that goes away. And what we didn't put up was the Fed's balance sheet. We've talked about QE and QT in a previous piece. That was a highly educational piece to explain QE1 through QE4, and then QT1 and QT2. We're in QT2 right now. All of that is also cyclical and part of the Fed's monetary policy and part of what drives investment returns.
I'm going to hold off on the actual correlation conversation for a little bit longer, because all of this is essentially implying that the next cycle is in fact a recession, that we're due for this correction, and it is a necessary and healthy part of a growing economy. You don't just go straight up. So it is inevitable that we would have this, whether it is exaggerated because of what we've done over the last 2 years. We will unfortunately have to bear witness to ourselves. But something that you guys have really emphasized at the Bitcoin layer is this is Bitcoin's first real attempt at going through a recession. I want to first just maybe touch on or set expectations for both P, Nick, and even myself of what expectations are for Bitcoin as it enters this period of a general market recession, not a Bitcoin recession, but a general market recession, and what Bitcoin can look like on the other side of this.
I believe, and this is, we're going to be writing about this for tomorrow's issue. I basically believe that the recession that we see starting now has been priced in by Bitcoin over the last 12 months. And that the drawdown that we saw was the market pricing in recession. So stocks go down 33%, Bitcoin goes down 70 plus percent, and that's it. And so that would mean that we're heading into a modest contraction or recession that has started already. That will be over maybe by the end of this year. Asset prices start to head back up. The chart on stocks looks much worse than the chart on Bitcoin, which has returned to a lot of fundamental and longer term valuation metrics and kind of returned back to scratch, where stocks are still a little bit above that level. Another thing that we have to be watching now, and we are watching, is the Ethereum to Bitcoin cross and what behavioral implications that has on the cycle, because we would expect that ratio would come down as we're going into contractionary period as risk goes off, but that it would resume going back up in a risk on period. So I think that there's behavioral implications from the Bitcoin price, the stock market, the Ethereum Bitcoin cross, and of course rates. You guys know I do price study every day. And so that is what I'm watching. I'm watching the suite of prices to tell us, have we bottomed or have we not? And what I said about Bitcoin pricing in the recession, that's becoming my base case, is that the recession is here and Bitcoin already priced it in. And we had all the flush that we needed to have. We'll see, we'll do the research, we'll do the price study. Well, if Bitcoin goes back down to 15,000 from here, we're actually talking about probably looking at a very deep recession, because the liquidity profile and global macro is showing it. That's what Bitcoin represents now. Bitcoin is actually a big daddy, like in the global macro scene, in terms of how well it's forecasted this current recession. Big ups to Bitcoin for showing the market the direction. And I mean it tongue in cheek, but it's actually, it's an important takeaway. Bitcoin is fully part of the global macro play because of the way it's responded to this recession. We have to look at the correlation with equities and understand that Bitcoin was also pricing in recession right next to stocks. Who's in the driver's seat doesn't matter. They're sitting next to each other. Risk A and risk B doesn't matter. Beta is high in Bitcoin versus the stock market. They are both forecasting the economic slowdown or the recession. So what is Bitcoin's role? It's actually to tell us when, how deep the recession is going to be, when we've bottomed, to lead by 3 to 6 to 9 months in terms of when the economy bottoms. And then I know you want to talk about kind of our discovery around the stock market and Bitcoin's correlation with each other, but let's save that for the next question. The takeaway here is that if Bitcoin's price bottoms here, we're going into maybe a short recession and we'll be out of it. But if it goes much lower, it's probably signaling a much deeper recession, a deep recession, which I'm not forecasting, but that's it's not my base case.
And to be clear, when you say that it's forecasting a deep recession, you're saying forecasting a deep recession in the broader macro or in the broader market.
Yes. If Bitcoin went to $10,000 from here, to me, that means that the stock market would be going down 50 to 60% from its peak at the end of 21, and that a 50 to 60% decline in the stock market usually corresponds or would lead a deep economic recession in the broad US economy.
Yeah.
By several months or by a year would lead that, and we would see that. And because of the strong relationship of Bitcoin to stocks, and because of price being, an indicator of so much truth, if we were to see that decline in Bitcoin, it would actually be a leading indicator of a deep, broad US recession, much to the surprise of all of us, really, that Bitcoin would be able to give us this true market signal completely separate from the risk-off narrative that we hope for Bitcoin to be. Completely separate.
Yeah, I think that's really
it's
interesting.
The complete opposite. It's the full risk indicator, but leading every other asset class. It's mind-blowing, but it actually is probably what is unfolding before our eyes. We won't be able to confirm it for another 6 to 12 months from now. I hate sounding like an economist. I'm far from one. I'm a trader.
I have terrible news for you.
I'm a trader and a price student. And so I will let the markets tell me if I'm right or wrong, not any economic indicators or anything like that. But we do have to do price study ex post, and we have to look back and see were our theses right about, Bitcoin being a signal.
I actually love this thesis. I've been very vocal that I've actually been using Bitcoin as my leading indicator for the NASDAQ and been trading QQQ puts based on Bitcoin's price movement. So I do love, I think, the thesis. I'm a little maybe lost on how you're drawing that conclusion, though. For myself, these are assumptions that I'm just gathering from what I'm seeing. I'm viewing what the price movement of Bitcoin directly related to private money, hedge fund managers, and so on, who do not need to publicly disclose that they're buying or selling Bitcoin. Most don't have to do that. And they have their own beta calculation for Bitcoin and have in turn moved portfolio allocation accordingly. We're seeing a rise up in the Bitcoin price. And in my head, I'm seeing, we are 9 days away from the end of the quarter. Bitcoin's price is going up. If I think that this is just being treated like a risk on asset by fund managers, they probably have an allocation percentage that they're supposed to have for some of their clients. And they're just trying to get to that allocation amount by end of quarter. And then the dump will continue. I'm curious if that is in any way incorporated, or you're thinking in a similar fashion that there is some private money being put into the Bitcoin market ecosystem. And that's part of the reason why you're seeing it trade almost in tandem. Chris, if you could pull up that chart where you guys highlight since January 1st, there's been a 90% positive correlation since January 1st, 2017 between Bitcoin and the general markets.
Yes. So I don't really look at calendar effects. I think that it's a little too short term for what I'm trying to look at. So I don't really look at calendar effects. What I'm looking at with this correlation is part of what you're saying is that now a lot of these hedge funds have their allocation and it is a beta play for them. And so they treat Bitcoin and stocks in the same risk sleeve and then have their beta weightings to allocate to each. So, quarterly effects where, stocks go up with Bitcoin at the end of a quarter as they're allocating or that kind of thing. That could be a result of this idea that Bitcoin is, again, it's on this hedge fund stage and has been, very obvious for the last several years due to this, 90% correlation that we have. And the big takeaway that we are making at the Bitcoin layer and understanding the correlation and how we should think about it is that Bitcoin is a risk asset for the money players that are affecting the market. We see that due to correlation. So when they're making those moves, they're making them as in tandem with stocks and Bitcoin. But if we look at when Bitcoin does its parabolic thing and doubles, triples in a quarter in this rapid fashion, the correlation to stocks breaks down because something separate is happening in the market during that time. So what would the takeaway for that be for investors? It would be that Bitcoin is going to be subject to the cycle and global macro risk 90% of the time, but for 10%, it will act on its own fundamentals. And historically, that has been when Bitcoin has gone up in a parabolic fashion, not when it has gone down. When it goes down, the correlation goes to 100%. And so Bitcoin exhibits a ton of cyclicality along with other risk assets, except for when it doesn't, which is a very short amount of time. And during that short amount of time, dramatic things happen that we have to point out and explain in order to explain Bitcoin's 100% compound annual growth rate that it's shown since its birth. So it's actually a common sense discovery that we made to try to explain how Bitcoin can go from 1 cent to $50,000, but still be 90% correlated with stocks. There's a missing piece of the puzzle, and we believe that we discovered that, and not even this huge discovery, but more of a common sense way to explain the divergence over the long-term time horizon, while also staring the reality straight in the face that Bitcoin and stocks are correlated and Bitcoin is a risk asset. That's what the market tells us.
Let's dive into that explanation, because I think you guys did a very excellent job of explaining the cycles and showcasing that over the course of each of these Bitcoin bull cycles, the correlation has diminished slowly over time, implying that yes, Bitcoin is decoupling, and we're probably 5 or 6, maybe even 7 more cycles away from really feeling that. But can you break that down? And Chris, this is that last little grid with the 3 lines and then percentages on the other side.
Yeah, so what we really need to explain this better, and we'll work on this, as a correlation matrix across asset classes. And what you'll see is that stocks and copper, for example, can be correlated at 1 during certain times, and then no correlation during other times. Different correlation regimes. We go through different correlation regimes across asset classes. Sometimes, most times, equities and corporate credit spreads are moving in a correlated way, where corporate spreads are widening and risk assets are declining. We get that sort of situation almost every day. But for times, credit and equities perform differently. So over a long-term time horizon, we should look at asset class correlations to give us a sense of really how independent these things are from each other. We would see that corporate spreads and equities are highly correlated, and copper would be much less correlated. So right now, Bitcoin and stocks are highly correlated. How long will it take for them to go less correlated? I don't think we're going negatively correlated, because for so much of the time, it's behaving like this risk asset. But yes, it does have its own fundamentals, so it should decline over time. It is declining over time marginally, and we'll have to just continue to observe this ratio. And we'll also have to continue to observe, like, when Bitcoin does its next parabolic thing. What have stocks done during that time? That'll be another empirical data point in proving out some of these theories. Keep in mind also, guys, that when we read, like, I studied finance in school, I studied portfolio construction. They look at 50 to 80 years of returns. The whole study is based off of that, like 80 years of data, right? And really, at best, 50 years of data. When they're trying to see, how should we build a portfolio? What's the best balance between risk and reward? People know it sometimes as a Sharpe ratio. This is balancing expected return versus expected risk. All of these theories are based off of 20 to 30-year-old theories that are based off of 50 to 80-year-old data. So as it is, it's not that much data that they've used to build all of this theory. Now we come into Bitcoin and we have a minuscule amount of data points to build out theories on how Bitcoin portfolio should be constructed, or how a portfolio should be constructed alongside Bitcoin. Bitcoin went from 1 cent to $1,000 in its first 4 years. So there's so much noise in the young history of Bitcoin that all we are trying to do is put some theories out, test them over time. Each halving cycle, we get more data points to prove or disprove the halving theory. Each time we have a recession, we get more or less, more data points to prove or disprove the correlation theory. And so how many data points do we have in halvings? 3. How many data points in recessions? 1.5. It's not much. So we just do our best. We're trying to cover this. We're trying to narrate the transition toward a more Bitcoin-centric world, and where Bitcoin is part of global macro. That's the mission of the Bitcoin layer.
You guys have been instrumental. You especially, Nick, have been instrumental in my Bitcoin education, and genuinely the Bitcoin layer is one of my favorite newsletters that I receive. So if you are not already subscribed, you absolutely should go. It takes you no time. There's a free version. He has a paid tier on the Substack as well. But I personally am very excited for a lot of this content you guys have churning out. And I want to just freely, in the middle of this interview, remind everyone, if you are not yet subscribed to this channel, subscribe to this channel, but also be sure to subscribe to all things Bitcoin layer. I do have a question, and I will be completely honest. I'm messaging Joe because I'm a little perplexed and candidly surprised that you were seeing this 90% correlation since 2017, based on brief periods of extreme low and negative correlation when Bitcoin is obviously pumping, as you mentioned at the very beginning of our interview. What, in your opinion, though, is the root cause of the decline of this correlation, and what can we be doing to help further enhance this decline at a faster rate?
What can we be doing is not much. The only thing that talks here is money. So, trade it outside the hedge fund sphere to affect the Bitcoin price. I can't. That's literally the only thing that we can do here. Money is the only thing that talks, right? And so, I believe that the numbers that we have on the screen are weekly correlation numbers, and so those are weekly. That's a weekly look at the strength of the correlation. Why is it declining over time? Again, Bitcoin does have its own fundamentals. Bitcoin isn't a slave to the stock market. It is allocated in the same funds that have a lot of money that move the market. That doesn't mean that stocks are Bitcoin. In fact, stocks are not Bitcoin. And so there is a different set of supply and demand dynamics on Bitcoin that will make it trade independently of stocks for, it doesn't even matter if it's some of the time. The only thing that matters is that some of the time it does. So why are we seeing a declining correlation? I wouldn't make much over this, decline. It's not a ton. What we know is that it's non-1. That's important. That it is declining is a good statistical sign, right? But statistics don't tell the full story, because what does a 0.8 correlation means? It just means that most of the time it's correlated, and a very small amount of the time it's not. 0.9 means the same thing if you wanted to make it into a sentence. They mean the same thing as each other, right? 0.9 and 0.8. But at the minutia level, yes, it is declining. So more of a story can be told if we get down to 0.7, 0.6, 0.5 over the coming years. Also, what we're focused on is whether or not during the next parabolic move or whatever period of time the correlation breaks down. Why did it break down? What is the takeaway from the breakdown? How long did the breakdown last? What did Bitcoin do during that time? What did stocks do? And try to make some sort of conclusion based off of that as well.
So, go ahead, Q.
No, please.
I was just going to ask, what is the ray of light in all this? We've been talking about this potential incoming recession and everything else we've touched on today. What is the positive aspect in this? Or what do you draw positive associations with? What should we draw positive associations or conclusions from?
I like to keep it simple and remind myself and people why I'm in Bitcoin. Why is it that I've chosen Bitcoin as the avenue to express my views and to do and conduct my research? Bitcoin is a better money for our present society and our current generation, the next generation. It's a better money than government money because of the risks inherent in central banks and governments. That's what I believe about Bitcoin. So just because Bitcoin is owned by hedge funds and shows a 90% correlation doesn't change the reason why I believe it's a more fair money. I actually love Bitcoin, and I use that word, with all of its meaning. I love Bitcoin because I think it presents a societal change that excites me to the core, in the same way that the internet excited an entire generation because we could talk to each other without the government. How amazing is the internet? And it's like, it's really, it sounds stupid to kind of pin it all on that, but how amazing is it that we can all talk to each other all the time online? We have YouTube, we have Twitter, we have the next decentralized iterations of these platforms. Doesn't matter. YouTube is the one with 2 billion people on it. And we're all on YouTube learning from each other, teaching each other, communicating with each other, nobody in the middle. We have a YouTube censor that sometimes gets involved. No comment. We have what we have. And it's a blessing and it's a freedom. And it started in the United States of America too. All these ideas. The freedom of speech, Every social network, American. And what is Bitcoin? Bitcoin is the same thing as the internet, but for money. It's finding its home in America because we believe in freedom and freedom of speech and freedom to express and freedom to transact. And we're setting an example for the rest of the world that this is an ideal. Bitcoin is an ideal that is in the light of American ambition and entrepreneurship and freedoms. And the rest of the world looks at us and says, why are you guys obsessed with Bitcoin? It must be good. There must be something there. And then they find what they find from it. Like the rest of the world. Did the internet start there? No, it started in California. And Hal Finney is a Californian, and I'm proud to be one and share the home state with Hal Finney.
I'm here with you, Nick.
Cali represent. And so the rest of the world is using the internet. It's helping them do amazing things. Where did it start? It started here. And Bitcoin has to be that effect for the world. The same way that the internet has changed the world, Bitcoin will do that. That's why I'm here. That's my takeaway. And so who cares about strong correlation to stocks? Talk to me about our society, our planet, the next generation. I have a 4-year-old daughter. What do you want from the world? I want Bitcoin to be an option for us. That's it. And I believe Bitcoin will have a lot of success, but I'm not super into the hyper Bitcoinization narrative. As long as it's here and it's growing and it's alive and it's embraced and the spirit of it is acknowledged. It doesn't matter how many people. There are people that have it that use it. The number will grow as well, just like population has grown that uses the internet over time. You have to compare it to internet adoption, or else you're missing everything.
There was something circulating on social media, Twitter especially last week, of the idea that, the Lightning Network cannot scale. And I want to piggyback off of what Nick's saying to really explain for everyone to fully debunk the FUD of, well, not everyone could run their own node and it's too hard. There was a point where people were saying that about putting an internet connection in your own home, let alone a computer in your own home. And with the exception of my parents' home, which only last year decided, let's actually get off of hardwiring cables and actually introduce Wi-Fi in the 21st century into this household. This was the last house in Los Angeles that didn't have Wi-Fi. Everyone has a Wi-Fi modem in their own home. That was unimaginable when I was a kid. I remember the commercial that Best Buy had actually when laptops started to become at the forefront of computer innovation, and the idea that you could have a wireless connection, and there was a puppet that was walking around, and the Best Buy clerk says, but this is all wireless. So you don't need to worry about all the plugs getting in your way. And then the puppet, being a puppet, was fantasizing about not having all the wires on it. Anyways, I've digressed and lost the plot. But the point being, to Nick's point, the adoption of this may be difficult for many people to grasp. And it is as simple as, hey, there was a moment where a computer took the whole floor of a building. And now I have a computer right here in my pocket, let alone right in front of me, and what's recording this has the computer processing power akin to some of those early day computers. So I digress. I do want to ask you, Nick, on the topic of just regulatory expansion in the Bitcoin realm. We saw last month, about a month ago, New York put forward some legislation that was pretty anti-Bitcoin mining in their state. At the same time, states like Texas and Wyoming seem to be at the forefront of bringing in Bitcoin miners. Where do you, I think, what would you say to some of these FUD spinners around Bitcoin and its energy use? We'll start there.
value proposition of Bitcoin is that there's no counterparty. It's a commodity and not issued by any central party. That is the entire value proposition of Bitcoin. That's what Satoshi discovered, was how to do that. And so for that to be preserved, we have to have a bunch of miners on around the world to preserve that decentralization. So what's the issuer of Bitcoin? All the miners that are on. Who owns the miners? Hopefully a diversified enough set of profit seekers. And that's the mechanism that we have. It doesn't really go beyond that. What do you value the energy that you consume? How do you value the energy you consume? The world has valued Bitcoin's energy with a price, with a market value. That's the value. It's not anybody's job to tell other people how to consume the energy. This is one of my biggest problems with the narrative out there. The United States telling China and India, stop burning coal. You're basically saying, stop turning the power on. We'd rather you die than burn coal. That's the same thing that you're telling Bitcoin miners. Turn the power off because Bitcoin isn't worth the energy of the planet. And that's our choice to tell you to do that. So it's a preposterous proposal to say, turn the Bitcoin miners off, just as it would be to tell a country without any clean energy infrastructure to tell them to turn the coal plant off. It's inhumane. It's not fair. It's not an equitable request from one segment of the population to the other. We all share the same planet. Let me decide how I want to consume my energy in my own way. And I'm not talking about destroying the society by consuming energy. I'm taking a good out of that energy consumption, just as the person in India is probably cooking with the gas from the coal power plant, or cooking from the energy from the coal power plant, cooking food, heating water. So you can't pick and choose how other people are going to consume their energy, right? Especially with those that fly private jets.
I mean, what you've described is, in essence, what Sri Lanka is dealing with. They're dealing with the repercussions of trying to have these developed nation policies without the funding and ability to actually adhere to it, and in turn have cratered their economy trying to adhere to these bullshit ESG standards that even we don't adhere to. Sorry, this conversation is getting me a little riled up, and I'm ready to fight someone, honestly.
Get into the darkness, embrace it.
Nick, is there a commodity, not oil, because everyone keeps saying oil, and like, yes, I get it. Oil is very important, but is there a commodity that you're paying extra close attention to that maybe could be another indicator beyond just Bitcoin to prelude some worse stuff happening, if you will?
Honestly, no. I think that the oil market has too many of its own fundamentals, and it can be a great macro indicator, but it can be noisy. So looking at the oil price is something I do for price study, but it's not something that's part of my core framework to see where we're going. And to be honest, neither is gold and neither is copper, and neither is lumber. I know a lot of people like to use lumber as well as a leading indicator. Other people like to look at agriculture commodities to forecast emerging market turmoil, perhaps, or stage of the cycle. None of that stuff is really part of my framework. You guys know me as a rates guy. I stick to that, and I stick to price study in the rates market. and I dabble in areas of risk like equities and other corporate spreads. That's really as far as I'll go outside of my lane. But my price study is rates based, and of course Bitcoin based, and I have added the Ethereum Bitcoin cross to my framework, my price study framework, in terms of a risk indicator and a cyclical indicator.
The correct answer was wheat, but nice try.
I was waiting for it.
Now,
Q has a deep.
Hey, I gave you the shout on the agricultural and the emerging market for the wheat, sort of experts and watchers out there, but it's not part of my framework.
No, like in Batman when he has that sort of really transformational moment where all the bats scream out of the cave and cover him, and he like masters his fear. I feel like Q had that, but it was with wheat, inexplicably. Just wheat blowing everywhere, trapped in a wheat field, being attacked by wheat. And then you mastered your fear, and you were like, wheat is the most important asset known to man.
I mean, in all honesty, I really don't eat a lot of bread or wheat. Like, I am in that camp that doesn't consume that good, but I'm also not naive that, hey, this is the main source of calorie. And we don't need to have this conversation with Nick. Nick, so we've talked a lot about yield curves, we've talked a lot about bonds and what your expectations are. Is there a limit to what you think the Fed is going to be able to do with raising rates, or will they be able to raise rates in a way that will just crater the economy?
There is a tipping point. At the beginning of the year, my biggest at the beginning of the year, what I wanted to communicate most to my readers was that the Fed is going to start hiking rates, and aggressively, and a bunch, and stocks will come down and the Fed will not care. I was pounding the table on this thesis that, the Fed will be raising rates. It will bring stocks down, and they won't cave right away. Inflation's at 8%. They will not cave. That's not on the near-term time horizon. Okay, now the Fed has raised rates 175 basis points since I started writing about that. So and especially with the 75 basis point hike last week, or 2 weeks ago. So we have passed that midpoint. Okay, that's where we are. We've passed the point where it's just obvious the Fed is going to be hiking completely eyes closed, blind to everything else, don't care about the stock market coming down or anything like that, don't care about GDP being negative or GDP trending towards zero, do not care about any of that. Now, guess what? The Fed's eyes are open again. So that's where we are. Their eyes were closed because they had to basically not embarrass themselves, right? Not completely embarrass themselves. They just have to save face a little bit. They hiked 175. Now their eyes are open. They'll be watching markets now. Okay. The next 20% decline in stocks, watch for the Fed speakers to start talking. Maybe not the next 5%, but that's where we are now, where I'll be watching the Fed, who will be watching the markets. I'll be watching the markets to see what the Fed is going to do. So I'm also watching the yield market, and right now yields are up. There's no sign of a crashing of 2-year yields. That's when we'll know, and also re-steepening of the yield curve, that the Fed is actually thinking about cutting rates. So I wrote a piece a few weeks ago about the relationship between 2-year yields and Fed funds. That was an important study to show that watch 2-year yields coming down to tell us when the Fed is going to cave or when the Fed is going to change course. Right now, 2-year yields are still at 3.25, 150 basis points higher than Fed funds. So that's permission from the rates market for the Fed to keep hiking. We look like 75 basis points in July is on. Otherwise, yields would be down. Front end yields would be down. 3-month yields would be down. 2-year yields would be down. But they're not. They're sticky where they are. So we're going to look for another 75 basis points. Then rates are going to be at 250 really quickly. 250 in March in 4 months. 250 basis points in 4 months is a lot of tightening. Then you really have to almost expect that they're near the end. Plus, they've said that 3.4 is their year-end target. So you're already, we're still 170 basis points away from 3.4. But then we'll only be 100 basis points away from 3.4. Then you'll have to start watching the end. So the next hike, 50 or 75 basis points, it's going to put us really in that zone of, okay, they're going to stop soon. How soon really depends on how the market behaves. But yeah, I don't think we're getting to 3.4 to 3.8 in Fed funds. But I also think that we're probably going to see the next 75 basis points easily in July.
It's a very scary time, to say the least. Not in my lifetime. P lived through the Great Depression, so he has seen things far worse than what we are bearing witness to.
It's true. I am a Highlander.
Nik, I want to respect your hard stop and give you sort of the last opportunity. Actually, there is one question. We always take one question from the audience. You know what the question already is. P, I will let you ask the final question.
Wait, I don't know which one you're
No, oh my God. You hyped this up in the chat, and I'm going to take it from you because you've just you lost the plot. Nik, why is Joe the best employee you have ever had?
Oh my God. Well, this
is the top comment. Q asked, like, hey, we're talking with Nik tomorrow.
It is a fantastic question. The asterisk is that it's both Joe and Matt. And
they're the same person. Got it.
They're not the same person. They both bring a tremendous amount of energy and ownership to this process. Joe is, a whiz with the charts, and he's a numbers guy, and he's a Bitcoin guy, but he wants to learn about rates through this process. And so I'm really enjoying working with Joe. And Matt just like has all the swish, and he's making us look so good with the visuals. And I'm really thrilled, guys, to be a team of three coming from a team of one. Really, the sky's the limit for us, and we're very excited to deliver 4 days of content now regularly, a Substack post on Wednesday and Friday every week, a YouTube video that's educational on Tuesday and Thursday every week. And there's just going to be a lot of content coming out, frameworks, trying to explain the whole macro framework in a very approachable and easy to understand way. And yeah, I'm just really amped for all of it.
I as well am amped to be watching. I know you guys just put out, I believe, the first video for a quick tutorial on what is the Lightning Network. There's a Bitcoin Layer YouTube channel. There's a Bitcoin Layer Substack. There's a Bitcoin Layer Twitter handle. And if you're not following the time value of BTC, Joe or Matt, you should be following the whole team. Nik, I'll let you have the final word, and please feel free to discuss or share anything else you guys are working on.
Yeah, the bitcoinlayer.com. You can find all of us, all the links. We hope you guys will subscribe to the YouTube channel and tell us what educational videos you're interested in. So I'll just tease a couple of the first ones that we have planned. We got the Lightning Network one. The next one is going to be a yield curve explainer. So a little bit similar to what we discussed today in terms of the yield curve. We're going to have our valuation framework for Bitcoin. How are we thinking about Bitcoin in relation to technical analysis, on-chain analysis, and energy input costs. We're going to have a duration explainer. What is duration and interest rate risk, and why do prices and yields move inversely from each other in the bond market? We're going to talk about repo. We're going to have basic Bitcoin supply explainer videos. You know, people that just don't understand, well, what happens in 2040? When the miners aren't earning income anymore and they don't understand transaction fees, or they don't understand the halvings? Basic stuff on the YouTube channel to explain for Bitcoin and macro, and then in-depth research and timely analysis on the Substack. I just really hope everyone will join us for the ride.
Thank you so much, Nick. It was a pleasure.
Thank you guys. Thank you guys so much.
Thank you for giving us your time, Nick. Be sure to subscribe to everything they're putting out. And if you didn't read Layered Money, don't admit that to me. Go read it this weekend. We're going to cut to a quick commercial break, and then we got a new episode of Fedwatch coming up. So stick around, guys.
Adios.
What is up, guys? Thank you for sticking through that commercial break. As promised, a new episode of Fedwatch. CK, Ansel, take it away, boys.
We got a good one for you.
Oh, yeah.
How's it
Everybody,
going?
welcome back to another episode of Fedwatch. It is a macro show for Bitcoiners with a contrarian twist. We have made some contrarian calls on the show, and they have worked out better than we could have ever dreamed. But we are live recording on Bitcoin Magazine's live stream. So for all those people that join in later on the audio version, mark your calendars for 3 p.m. on Tuesdays. We will be live streaming at that time every week. So come join us. Today, we're going to be watching some press conference highlights from Powell and Lagarde. So they both talked in the last 2 weeks. We haven't really covered that on the show here yet. So thought we'd go over that today. But before we do, Christian, welcome back. How are you doing? How are you handling the Bitcoin winter?
Oh man, what winter? I'm just excited to be able to increase my SAT denominated stack. It's only going up, so pretty hyped about the prices, and I'm pretty hyped to be in BTC Studios here, officially in Nashville now. So a lot of fun to be had here in Nashville, and I'm excited to make this room look a lot cooler and bring a lot of energy out of Nashville instead of San Francisco. But without further ado, let's get back into macro. a lot has happened. I mean, Ansel, we can talk about Fed raising rates despite what seems to be an economic collapse upon us. The economy potentially moving into a recession. This to many is thought that the Fed would be behaving in this way. But so I guess back to you, Ansel. What do you think? And maybe we should jump into some of these videos.
Yeah, tons happening with the Fed. We had Tone Vase on last week. Great show. So if you guys haven't seen that, go back and check that out. We didn't get into the Fed very much at all. We talked a lot about Bitcoin, a lot about the Bitcoin cycles and that kind of stuff. So this week we're kind of catching up on some of these things that we have let slip a little bit, but we do have Powell's speech. I took 3 clips, and I don't think, Christian, you had a chance to watch these clips yet. So it's going to be a cold reaction from you, which should be great. And yeah, then we go on to Lagarde, same sort of thing. She kind of came out and talked about their upcoming policy decision. So we have 3 clips from her, and we do this because we like to get the word straight from the horse's mouth. We like to get the make our own decisions, watch what they say, get a feeling for how they are in front of the camera. If they're lying to us, we can kind of get the spidey sense where we don't believe something, or we think they're being dishonest about certain parts or honest about other parts. And people should expose themselves directly to the source. That way they can make up their own minds. But that's all I have for the lead in. Should we go right into Powell's first clip?
Yeah, let's definitely do it. And I guess, do you want to give any context before Chris puts it on?
I mean, this is their press conference after they come out with their decision. So the way it works, when the Fed makes a policy decision, they will release it on their website. I think it's like 2:30 p.m. And then about a half hour later, Powell comes out and talks to the media. He has a prepared statement, and then he takes questions. So that's what we're going to be watching clips from.
Let's get into it.
Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices.
All right, Christian, you want to go first? What was your cold reaction to that? Any insights?
I mean, I feel like I have less insights than you will, but generally speaking, he kind of stated, a little bit of the obvious, which is we're increasing rates, and therefore, we're seeing some of the the housing market is becoming, is cooling down a little bit. We're starting to see changes in consumer behavior due to the increase in rates. But on the flip side, it just, I didn't get a whole lot out of it, I guess. Even when he was talking about what's happening in the labor market and how that's not really changed, I did see some articles talking about how all of a sudden, because the wealth effect is gone, people are showing up for their minimum wage job again. We'll see if that actually plays out. But what he's saying is that nothing has really changed, and maybe it's too early to tell if that dynamic has changed. But ultimately, when I look at jobs and what how people are choosing to spend their time, my base case is that is really distorted because of the economic hurricane that we find ourselves in. Nothing really makes sense. It's difficult to allocate capital, and therefore it's difficult to allocate your time and spend your time doing something that creates value but is fulfilling as well. So that's like one of the underlying issues with what is happening with a fiat based world. So not to go on a tangent, but yeah, I guess I'm very curious with what you think, Ansel, and I'm sure that you have a lot more insights to pull out of that.
Well, I love that you brought back in the economic hurricane, because we did hear that recently from Jamie Dimon at JP Morgan. And I tweeted, I said, yeah, we've been talking about that for over a year. But so yeah, on this particular
there's video
clip,
evidence.
yeah, there's video evidence on this particular clip. What I pulled out was he talked about some levels of economic growth and economic performance, but he didn't clarify whether these are nominal levels versus real levels, because with us, CPI going up at 8%, we could see real levels of economic activity falling by 7%, and they would still look slightly positive, right? So I think there's a little bit of wordplay happening here, a little bit of sidestepping, making some hard calls on Powell's part. And that's different for us, because we usually think that Powell is relatively a straight shooter. We've said that in the past here on the show. So I think
I guess it's easy to be a straight shooter when rates are going down, not the other way around.
Yeah, that's true. He's having to make some semantic choices here, because again, they aren't in control of these things, and he's trying to massage the message. So it's understandable.
Yeah, that's a really good observation. This is why I love listening to you talk about what's happening with the Fed, because I feel like you understand the dynamics of the person delivering the news or making the decisions a lot better, and you can pick that out.
Yeah, and he also said something we picked out previously was when they can't affect supply, they can only affect demand. And he says in here, in this little clip that we just watched, is that tightening financial conditions should continue to temper growth. So obviously, to me, that means that they're trying to induce a recession. And but later he's asked that direct question, which we will listen to here in a couple clips from now. But yeah, so they are trying to induce recession, tamp down on demand so that prices come down. He also said here that the labor force participation rate, or he talked about that, he mentioned that, and that was the only time in the entire 1 hour press conference that he mentioned the labor force participation rate, even though employment is one of their, is half of their mandate, maximum employment. And he only talked about labor force participation once. So I thought that was really interesting. But one thing that we didn't include in the clip, because, we're limited on what we can show here, is he did acknowledge also that oil prices are responsible for a high percentage of the CPI price increases. So I thought that was very interesting. Of course, he doesn't hammer that home or explain that anymore, and nobody asked the question. So he says oil prices are, responsible for a lot of this, but then he just moves on. So that's all I have for this clip. Should we move on to the next one then?
Yeah, no, I think so.
All right, let's do it.
We can't hear him. Having some technical difficulties.
A few technical difficulties.
The producer is going to get figured out. Oh, here we go.
Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected.
All right. So, Christian, do you want to go first again? This one, he was talking about adaptive monetary policy and kind of long-term projections and where he sees the rate going in the future.
Yeah, I mean, he's at least trying to set the expectations that rates are going to continue to go up. And really, the impression that I got from him is he is like, I am the doctor and the economy needs to take its medicine. So that's the impression I got from him. And he was like, hey, it's tough, but here's the medicine that we need to take.
Yeah, a couple words he used there, adaptive. He used that a lot. He used nimble. And one of the things from this rate hike was, it was projected at 50 basis points. And then only about 48 hours before the announcement, things started changing rapidly towards 75 basis points. And then they came out with 75 basis points. So they were adaptive and nimble to the situation. They did actually pivot, but they pivoted a little bit more hawkish instead of a little bit more dovish, right? And so I think what they're trying to do, or what he's trying to do here, is build in an expectation of future pivots. I mean, they are adaptive and nimble. He kept saying that over and over. So what do you think about that?
That the myth of the central banker is that they're this adaptive and nimble institution that keeps the economy in balance. I think that Bitcoiners already either don't believe in the myth or they think that their presence is detrimental, and that's why we're bullish on Bitcoin, because Bitcoin is a uncorruptible and a opt-in monetary policy. So you agree to run the rules and no one can change it. So you have assurances there. We think that is much more stable way to do things. So that's like the myth. And, I think that he's trying to expectation manage that reality like he has been. But I've been kind of harping on this idea that the Fed, has this golden goose, which is that, it has thus far been able to kind of manage expectations the way they want to. But what is really happening is the economy is actually doing things in the background, and they're finding ways to appear to kind of flow and stride with that. But I think that with these recent rate hikes, when they stop rate hiking, and things may not respond the way that they want the populace to respond. And I guess what I'm trying to say is that I think that they potentially could have killed their golden goose. They may have, by really pushing us into a recession, they may have put themselves in a situation where they can't save the economy. And then what? once we're in that recession and they can't save it because they actually don't have power, the king, is caught without his clothes on. And I think,
Yeah. I didn't get that last bit there.
sorry, no, I said, and I just think that that's very dangerous for them.
Yeah. I think what I was trying to point out was that they are, or Powell is almost like trying to create this MO that they can adapt their monetary policy very nimbly, and they can move, 75, it's okay, 50, it's okay, 25, it's okay. It doesn't really matter if we're going to do this, but we're going to do what's best. And I think that is kind of dangerous, because people expect them to know what is, be very confident in what they're doing. So I think that could work against the confidence of the Fed going forward. One thing I wanted to ask as well was, this is kind of related because he talked about quantitative tightening there, is do inflationists think that quantitative tightening is deflationary? Because we heard for 12 years that QE was inflationary. Well, is QT deflationary? And what's your take on that whole narrative there?
I think QT and QE economic chaos, and ultimately the system can't really it takes a while for the system to kind of adjust to accommodate for them, and then when they manipulate those things, it just creates more chaos for the economy to try to deal with, and for individual economic actors to deal with. So whether one does something or another, I think it's impossible to tell what they actually do, because it's all kind of going into a blender of craziness. But I do know that they create chaos. So the more that they are used and changed and destabilized, and the more change that is being done via intervention, I feel like that creates chaos. So I don't really have a strong opinion about what one actually leads to, but I think that they both create chaos, and they both make it difficult for individual actors on every level to make sense of what's happening. And again, that's why I say that's why we Bitcoin.
Absolutely. He also talked there about inflation expectations, and I prepared a few charts. If we could pull up chart number 1, if Chris has that going. Maybe. I had a lot of material for you guys this week. Behind the scenes, guys.
Chris is
are
on
awesome.
top of it.
Yeah.
Thank you very much, sir.
Yes. So not showed here, but I want to mention it before I talk about this, break evens, is the Fed does a survey of inflation expectations. And that's what he talks about a lot here, Powell, in this press conference, the Fed's inflation expectations. And again, that's a survey, and it's showing over 8%. All right. Now, it's hard to square that with these charts that I'm about to show here. This 5-year break even is the difference between the inflation adjusted 5-year treasury and the uninflation protected treasury. So this is a market rate directly from the market, and it's showing that it's the expectation on the 5-year break even is, I believe it was 2.8%. And then if you go to the next slide, is the 10-year break even, and that's showing 2.4%. So that is the expectation. The average inflation over the next 5 and 10 years by the market is basically about 2.5%. The next chart I have is the 5-year forward, and that is the kind of gold standard, or the Bitcoin standard of inflation expectations, and that is the second 5-year period from today. So not 0 to 4 years, but 5 to 10 years out, and what the market is expecting for that period. And so this is not a survey. This is based on a algorithm calculating different interest rates, different things like that. And it's showing the same 2.4% roughly. So all of these numbers, the reason why these are lower, in my opinion, is that this is actually the measure of inflation. This is actually the money printing side of CPI. So the other half, so from 8.6% or whatever we have for CPI compared to this 2.4%. So that's 6.1% of the CPI is from supply chains, the supply chain disruption, oil prices, food prices, that kind of thing, due to the war over there and the sanctions in Europe. So that is what I take from this. And when Powell talks about inflation expectations, he's looking at CPI expectations and not monetary inflation, actual printing of money. So that's all I have for these charts. Christian, what are
Yeah,
your
no,
comments on
I would
that?
love to stay on these charts and just kind of talk about it a little bit. Like, I think this is the basis of our quote unquote unpopular opinion on this show, is that it's very difficult to tell what is inflation, because everyone is using different definitions of that. So,
Yeah.
and then what the CPI captures does in any index that's trying to quote unquote capture inflation, that's not strictly counting like notes being printed, or what you're showing is expectations of inflation in terms of pricing, then what it's doing is it's capturing disturbances maybe in prices, but it's not actually capturing quote unquote money printing. It's capturing disturbances. So those disturbances could come from anywhere. Right now there's an enormous amount of disturbances. There's sanctions on key commodity providers. There's war in key commodity and food and wheat providing region, in a resource rich region. There are global supply chain disruptions because of COVID lockdowns and changing health movement protocol, and differentiating health movement protocol across the globe. Like, there are a lot of just crazy curveballs being thrown at ordinary people trying to do business, right? And that affects prices. That affects how many things can get on ships and get transported, and how many things can get built in a factory, and how many things can get grown and produced into food, and how efficiently that can happen. All of that is being disrupted right now. And we're not even talking about, the fact that oil is kind of like a base price increase on everything, because everything pretty much requires oil directly or indirectly.
Absolutely. And a lot of people might question, oh, why are they being sticklers for this? Why do people care where the inflation is coming from? The prices are going up, but that you need to identify the proper source of this if you want to make rational decisions in the market, right? So,
So
by the Fed and other
maybe we
people,
can,
go ahead.
no, maybe we can drop out of the screen. But I was going to say, I think, say exactly what you were about to say. So I just pass.
Yeah, so we need to identify the right thing, because the Fed will talk us into the next recession. The Fed will, mess with our money supply. And if we want control of our money supply, if we want control of our destiny, we need to know the truth, where these price increases are coming from. And also, I've said this recently now, and it's not very popular to say, but price increases that aren't due to money printing, so this is like supply shock stuff, those are informational. Those are good, because you can make more proper economic calculations if you have good price signals. The problem is money printing, because money printing creates the inability to know the truth in the economy, because all the price signals are messed up. They're not actual, the truth of the capital allocation out there, and demand, and all of that stuff. But when you have supply shock, those price increases are informational. They're good. You need to know that information so that you can make proper, economic decisions. So that's all I have for this one. I did have one more chart if we want to do that one. This is a famous chart that we haven't looked at in a while. It's the reverse repo. Yeah, there you go. The reverse repo, it hit a new record high at 2.22 trillion. And when I look at this chart, I see the dollar milkshake theory from Brett Johnson. And that is where, the dollar is going to get stronger, because it's going to suck all the liquidity out of the global financial system. And that's what I think is represented by this reverse repo chart, is people parking money at the Fed, parking liquidity at the Fed, and it keeps going up and up. Now, what's interesting as well is in this press conference or at this FOMC meeting, they raised the reverse repo rate up to 155 basis points. And that puts it far, far above any sort of Japanese bond, German Bund, all from the 10-year down, 10-year out. It puts it above the most of the German long bonds. And so if people are looking for a place to put money, why wouldn't they put it in the reverse repo at the Fed? I mean, it's the safest of the safe bet that you can make. You're lending right there to the Federal Reserve. So I think this is interesting. I expect this to expand, continue to go up. And over the next couple months, we'll probably hear a lot of talk about this. I can see this maybe getting up to 3 trillion within the next couple months. So any reaction to this chart? We haven't looked at it in a while. Christian.
I mean, if I said I was like an expert at, understanding how this fits into the dollar system, I would be lying. That's where I have to really rely on you, Ansel. But I'm curious, does this compete? Like, is this the current store of value? Like, how does this kind of like stack up against other kind of opportunities within the dollar stack, treasury bonds, etc.?
Well, the reverse repo rate at 155 basis points is very far above the 4-week rate. So I looked this morning and the 4-week treasury bill was 1.09%. So this is almost 50 basis points higher than the 4-week treasury bill. And that brings up a question that Jeff Schneider brings up a lot is how on earth is the 4-week rate below the overnight rate? That doesn't make any sense. Like, why wouldn't you just go to the Fed in reverse repo, and get 1.55 basis points or 1.55% instead of 1.09%. So there's a lot of things that we can take from this. I'll have to do a whole nother show because it, goes in depth, and I could probably talk for 20 minutes on just that. And we got some more clips to get to.
All right. Yeah. So we have a lot more clips to get to. I guess last words before we get into this next clip.
Well, I'll just set up this next clip real quick. So it's past the, he has prepared comment section, and then he goes into Q&A. And so this is part of the Q&A. During this Q&A, people ask him about the unemployment rate, because he says that he wants unemployment to go up. And people don't like that. That sounds really weird. You want people to lose their jobs. So he's asked a couple times about that. And he's talked about inducing recession in this clip. So let's roll the clip, guys.
Hi, Chair Powell. Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple of years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger or longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
All right, so that was a longer clip. That's the longest one that we have here. I just want to point out that, he did talk a lot about the unemployment rate there and that they need, okay, so you can't have, they don't think that you can have a stable economic recovery if you have too low of unemployment, because the way that they look at it is low unemployment means that there's competition for wages, and that will push wages up, and that will give people more money to spend, and it will be a feedback loop for inflation. So their goal here is to raise unemployment, which is kind of counterintuitive. And I don't think it will work, but that I'm just explaining what they're saying. He also mentioned that they have to control the things that they actually have control over. They, affect the demand side. They can't control oil prices. They can't control those other things like sanctions over there in Europe. So, and the last thing I will say here is he said that we were expecting more progress and we didn't get that. So to me, that's like, okay, well, you were wrong then, you're going to be wrong again. So what's your take there, Christian?
Man, well, I keep tweeting and talking about this. They're killing the golden goose they never knew they had. This wealth effect that was going to their benefit, they're now killing that, and now the world is seeing that we are in this massive cluster F, and there's nothing the Fed can do, as they admit, about it. Right? There's nothing they can do to fix the oil shortages. There's nothing they can do to fix the supply chain issues. There's nothing they can do to fix the state of the economy. All they can do is manipulate the plebs that are under their jurisdiction with tools that don't even work and end up actually making the situation worse. But yet they have to, straight face lie to you, the Bloomberg journalist's face, by saying that, hey, this is a healthy jobs market and economy, which everyone knows is not true, because I'm driving down the road. I just drove across America and I keep seeing diners that have signs saying, employees needed, employees wanted, all this work that is available. But guess what? No one who could actually, afford to live on the wages that they're, economically able to pay can even live within that jurisdiction. Or it for whatever reason, it's easier just to get whatever social security or welfare or food stamps than it is to go out and make those very low wages. So I think right now, again, we are in an economic hurricane. I think that the Fed is continuing to make it worse. what they're doing, they admit can't actually fix the supply chain issues. And I think by inducing a recession, they're just going to put us in a worse situation, and they're also going to expose their inability to actually do anything.
Yeah, I don't have anything to add on that, other than just to say, he's playing semantic games. And this is the first time that I watched Powell where I was like, man, he's not really being honest for the most part in this press conference. So anyway, we have about 20 minutes left. We got to get through all of Lagarde's stuff. So should we jump over to the ECB?
Well, I guess just real quick, do you want to play psychologist on Powell and just
Oh,
talk through like maybe like what you think is going through his head right now?
Well, they're confused. They really do believe that there is this reinforcing cycle with unemployment. And we went through this with Yellen and Bernanke before, where they were really worried about R star, which was maximum employment, or, like the variable for maximum employment. And it never really worked. They were always behind the curve. It didn't, like Powell said here, they were expecting more progress. They were always not getting it right and failing to predict where the economy was going to be just 6 or 12 months ahead. So this is just, they are unable to shift to a new idea. There has been no economic scholarship in the last 20 years of like real progress in economic scholarship. I think all of the economic scholarship has happened here in Bitcoin. And so it might take another 5-10 years, but eventually these central bankers are going to, like Saifedean might become real high up there in the academic literature for economics, because he is making original content. And really the academics at the Fed, they just haven't come out with anything new in a very long time. So that's my kind of take on it.
So you think that this dip is catching Jerome in a tough spot? I would think everyone's in a tough spot because of the dip. Do you think he's in a tough spot?
Yeah, I think they don't know. They are incapable of really affecting the market. All that they can do is maybe guide it to a soft landing. And so that's what I think they have been trying to do for the last six months or 12 months, really, since they started talking about being hawkish again. So I think they're just trying to maybe raise rates at a fast enough pace so that they have room to cut again. They're just trying to get ahead of the narrative, and that's all they're doing. And
yep.
So
all right, let's move on.
I don't want to take too much time on Powell.
Yeah, I know we're tight on time. Yeah.
So let's there we go.
High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term. In May, inflation again rose significantly, mainly because of surging energy and food prices, including due to the impact of the war. But inflation pressures have broadened and intensified, with prices for many goods and services increasingly strongly. Eurosystem staff have revised their baseline inflation projections up significantly. These projections indicate that inflation will remain undesirably elevated for some time. However, moderating energy costs, the easing of supply disruptions related to the pandemic, and the normalization of monetary policy are expected to lead to a decline in inflation.
Okay, so here I don't think she said too much substantial. I just wanted to have this opening clip because her kind of cadence and her delivery is so much different than Powell's. And a lot of people might not have ever watched Christine Lagarde talk about monetary policy. So I wanted to give this kind of opening clip. And any reaction right off the bat here, Christian?
No, pretty classic, and it's interesting to have to completely 180 from less than a year ago when she was saying inflation is transitory, it's not an issue, we have it under control. It's like one punch in the mouth, and it's rampant. And when they're talking about I find it's crazy because they're talking about they need to bring inflation down with monetary policy, but they also know, and we can refer back to Powell, that they can't actually do something about supply chain issues. So to me, it's crazy that they're calling this inflation. They should just call this price increases due to supply chain breakdowns, and not think that they could actually fix that with monetary policy, because all they're doing is they're actually adding a more chaotic element to the mix, and that's not helping. This is like the key point that we're trying to drill down in. I'll just get off my rant already. I'll keep it short, but like the inconsistency remains.
Yeah, and I mean they blame the war, but the war really doesn't stop oil from flowing, right? It's the actual sanctions that they're putting on. So they're once again they're diverting attention away from the left hand so that you don't see what the right hand is doing. Same thing with, hey, this is calling it inflation when it's not, and blaming Russia when they should blame themselves because they are doing the ones doing the sanctioning. So,
but what choice do they have, right? They're not willing to fight. We don't have to talk about this. I just wanted to throw that wrench in there.
Well, I heard something interesting. I can't remember who said it, but it's somebody that I just watched a podcast on YouTube from this morning, and they called it a economic blitzkrieg. And I thought that was a really good way to put it, that they are trying to do war through economics and really they tried to crush the Russian economy with this economic blitzkrieg, but it didn't work. So now we're kind of seeing what the fallout is from that. But anyway, let's move on to the next. Let's move on to the next clip.
Throughout this process, the Governing Council will maintain optionality, data dependence, gradualism, and flexibility in the conduct of monetary policy. First, we decided to end net asset purchases under our asset purchase program as of July 1st, 2022. The Governing Council intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it starts raising the key ECB interest rates, and in any case, for as long as necessary, to maintain ample liquidity conditions and an appropriate monetary policy stance. Second, we undertook a careful review of the conditions which, according to our forward guidance, should be satisfied before we start raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. Accordingly, and in line with our policy sequencing, we intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. Third, beyond September, based on our current assessment, we anticipate that a gradual but sustained path of further increases in interest rates will be appropriate. In line with our commitment to our 2% medium-term target, the pace at which we adjust our monetary policy will depend on the incoming data and how we assess inflation to develop in the medium term. Within the Governing Council's mandate, under stressed conditions, flexibility will remain an element of monetary policy whenever threats to monetary policy transmission jeopardize the attainment of price stability.
All right. Well, I just had to put this in here. I mean, I wonder why they do it in English. Like it's obviously now in the EU without England in the EU or Great Britain. Like it's English is everyone's second language. And so like they're given these big monetary policy speeches and where they're supposed to convey this very important thing in like everyone's second language. I don't know that I just got that from her cadence and from her, she's just being very slow. Did you notice that, Christian?
Well, I mean, I think that watching English as a language, its dominance insert itself is a good framework to kind of understand how a Bitcoin standard is going to really assert itself over time. Because ultimately, it's like it's the constant, and that's why it becomes the standard. And even if it's not the preference for everyone, they want their CBDC bucks or whatever. We'll get to a world where everyone will at least trust Bitcoin enough to accept it. And that's how the standard forms. So I just wanted to make that connection. And in terms of like what she's talking about, I feel like it's kind of interesting watching her follow the Fed, right? She's effectively 2 quarters behind the Fed in terms of these actions to quell inflation. And I'm interested to see if she's almost being bullied into this behavior when she was effectively saying no, full steam ahead, not very long ago, and the Fed was actually changing its direction to deal with inflation.
Yeah, great observations. She's actually asked that question by the very first question in the Q&A.
Shows how not smart I am or observant. It's just the most obvious thing.
She's asked that question if she's just following the Fed, and should we think of it like that they're just taking the lead of the Fed? And of course she says, no, don't think that way. But it totally comes across as, yeah, they're just 2 quarters behind.
She 180'd so hard. And like, she was literally giving the complete opposite opinion when Powell started, kind of changing his direction.
Yeah. Another thing I pulled out of this press conference that we didn't have a chance to show because we only had 6 clips here, but they talk about the Fit for 55 and the Repower EU programs. And I'm not familiar with these, but I'm assuming they're climate programs, like some sort of ESG type programs. And what she said specifically was that they're going to make the EU more resilient to global shocks. And I don't think anyone else probably picked up on this, but I call the ECB here Lagarde the Davos crowd. They're the globalists over there, and so they really like globalization, right? And they want globalization to continue. They want to be in charge of this globalized rule-based order, and so they really hate deglobalization or any talk of deglobalization. But right here, when she says that these things are going to make the EU more resilient to global shocks, to me, that's almost like letting the mask slip a little bit and show that, yeah, they're almost ready to accept that deglobalization is going to happen. And they are, I don't know, it just seemed like a very big moment to me, because I think of this globalization versus deglobalization all the time. And this struck me as very like in line with deglobalization.
Well, again, it's a complete 180. And just 2 quarters ago, she was talking about globalization, more globalization, and you were effectively laughing at her. I do remember that. Again, listeners, you can go back. We talked about it.
Yeah, something else she said here that's sounding exactly like Powell, again, like you said, is, quote, if demand were to weaken in the medium term, it would lower pressure on prices. So how do you weaken demand? Well, you crush demand by crushing people, crushing consumers, crushing the economy. So it sounds just like the Fed. All right, let's get on to the last clip of the day. This is working out pretty good timing. So this is a short one. And so I wanted to set this up. Yeah, I wanted to set it up real quick, is that it's about fragmentation. She talked about that very briefly in the very first clip that we played. But that is the idea that credit spreads from, the pigs, the Portugal, Spain, Italy, Greece, that these credit spreads will affect these more indebted nations a lot more as the ECB is raising rates, right? And there's this worry about fragmentation within the Eurozone. So she pounds multiple times saying, we are committed to anti-fragmentation. We have different tools. We're going to use all of our tools. But, she never really breaks down what she means by that. But anyways,
we've been talking about the breakup of Europe for a long time on this show too.
Yes. And the coming European debt crisis 2.0. This is kind of what we're talking about here. But this question that we're going to play, she just is getting frustrated because people keep asking her about this fragmentation. So let's roll the clip.
On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission. And we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances, of countries, how and when that risk is likely to materialize, and we will prevent it.
We will prevent it. We will not tolerate it, but we're not going to tell you exactly how, but we will not let it happen. So what's your reaction, Christian?
Yeah, just like they can't prevent oil prices from going up, they can't prevent that, but they can create a recession and make the plebs hurt in the meantime.
Yeah, I have an article here that I wanted to read through. So it's because a couple days after this press conference, because this is like almost 2 weeks ago now that Lagarde spoke, and the market did not like it. This anti-fragmentation stuff really kind of hit some bad notes in the broader economy. So the ECB came out and tried to fix it right afterwards. And so I wanted to read this article. This one is from Reuters, and the headline is ECB pledges new crisis tool to help indebted southern states. The European Central Bank promised fresh support for the bloc's indebted southern rim on Wednesday, tempering a market rout that threatened a repeat of the debt crisis that almost brought down the single currency a decade ago. Government borrowing costs have soared in the 19-country currency bloc's periphery since the ECB unveiled plans last Thursday to raise interest rates to tame painfully high inflation. But the bank failed to reassure investors it would contain the rise in borrowing costs, making only a vague pledge and stoking fears it was abandoning more indebted nations, such as Italy, Spain, and Greece, which have struggled for years under the weight of massive debt piles. Reversing course just 6 days later, the ECB said it would direct cash to more indebted nations from debt maturing in a recently ended 1.7 trillion euro pandemic support scheme, and it would work on a new instrument to prevent an excessive divergence in borrowing costs. Quote, the Governing Council decided to mandate the relevant Eurosystem committees, together with the ECB services, to accelerate the completion of the design of a new anti-fragmentation instrument for consideration by the Governing Council, the ECB said after an extraordinary meeting. But the ECB chief, Christine Lagarde, also tried to temper expectations, arguing that the ECB's job is taming inflation, not helping budgets. Quote, we cannot surrender to fiscal dominance, Lagarde said at a forum in London. Neither can we surrender to finance dominance. We have to deliver on our mandate, end quote. So that's what's happened since this meeting, and I think it's very interesting. It's going right down, step by step, down this European debt crisis 2.0, and we called it way back a year and a half ago.
Yeah, no, I don't want to stick long on this, but like think about this idea of both being adaptive, but not being able to adapt to like effectively having a mandate first and not a people first policy. You know, like that's a tough place to be. You both have to be, you both control, you don't actually control, but you control by responsibility and by, you know, what people believe you control. By name, you control, you know, what is going to happen. And at the same time, your mandate is not necessarily going to be people first. It's just a tough place to be. And again, like, this is why humanity needs something that isn't controlled or can be controlled or strives to manipulate. Like, this is why we urgently have to get away from this baloney. And this is why I'm so appreciative of Ansel for doing this amazing research and uncovering a lot of, you know, the dialogue, you know, people don't listen to, that they need to, so they understand the intention behind central banking and why it's not a good thing.
Absolutely. I will make everything available for the listeners and viewers in the show notes. So check out the Fedwatch the Fedwatch podcast feed, and I will be tweeting it out. So you can follow me on Twitter at Ansel Lindner. I also do a companion post that comes out hopefully within a few days of the podcast over on Bitcoin Magazine. But anyway, we will make sure we get you a link to see the charts and to watch these videos if you are an audio listener. So that's all I have today, Christian.
Yo, we got some good shows teed up. I'm really hyped for them. And yeah, I'm hyped to be in the Nashville studio. I'm loving what is going on with Q and P. Y'all can follow me at CK_Snarks, and back to the hosts.
Yo, actually though, don't follow CK. There's a company bet, and P and I are single-handedly trying to beat CK's total Twitter followers. So would actually greatly appreciate it if you are following CK, go ahead and unfollow him. Just so long as this bet is active, please.
I didn't know that I was participating in this bet, but now that I am, I'm absolutely on board for it. So,
well, I kind of figured the payout.
Don't report me. Don't report me. I don't want to get my Twitter
this is
account
not a
taken
real
away.
bet.
But it is a real bet. I don't know if you missed that, P, but CK has offered a bounty if you flip in him. However, I'm willing to split the bounty with you if we just say our combined follower base.
I'm 100% on board now. Let's do this.
No, that's not how it works. I set the rules, so you need to satisfy my criteria.
Just like a
but yes, there
banker.
is actively an open bounty for BTC Inc. employees who gain more followers than me. I will pay them out in sats. So far, only Dylan LeClaire has won this bounty, and he's crushing me now. It's not even close.
No, honestly though, I like the Joe Rogers model of let me just tweet out everything that Dylan LeClaire tweets. Ansel, I want to give you one last opportunity. Bitcoin and Markets was excellent last week, as always, man. If you're not subscribed to his newsletter, the newsletter in particular, you really should.
I forgot to plug that. Thanks, Q. Yeah, bitcoinandmarkets.com is my website. I do a free weekly newsletter there, just brand new, revamped with a new theme, a new look over there at bitcoinandmarkets.com. So check that out. And also, I just started a Telegram channel, so you can find a link to that on the website as well. Hopefully we can get that growing and get some good conversation going.
We'll have to link that here too. Let's go.
Absolutely.
Booyah. Guys, subscribe, follow the three of us, unfollow CK Snarks. I got to do my obligatory shills now, but ticket prices for Bitcoin 2023 are going up on next Friday. Ticket prices will never be this cheap again. I don't want to hear anyone bitching or moaning about it. This is the moment. You were going to have to fly wherever we were going to go. I believe all announcements are impending, right, CK?
Very soon.
Very, very soon. Where it's going to be, when it's going to be. I've already leaked. CK, I'm going to admit this to you while you're live on air. I have unfortunately leaked 2 speakers.
All right, don't leak anymore.
Okay, I'm going to leak a third.
And don't re-leak them. Don't re-leak them.
I'm going to re-leak the 2 and leak a third. So the first 2 I've already leaked are David Bailey and Tyler Evans. And the third one, I'm going to make this call now. Bold call. But CK will be a speaker at Bitcoin 2023.
Oh, shit.
Damn. All right. Well, okay. I'm okay with that leak. I'm sorry. I'm sorry for doubting you, Q.
And as always, it is everyone's favorite moment of the episode. Ansel, you do not need to be tortured by this. CK, you can stay and be tortured, but it is time for a dramatic reading of the Bitcoin Print Mag. And of course, get your copy of the Bitcoin Magazine store. Use promo code FOMO to get 10% off. The censorship-resistant issue has arrived. It is in Nashville. It is being censored as we speak. Stickers and blackout words or blackout marks are going all over this censorship-resistant. But back to the Moon Mag. Memetics with Maury Coleman. The power of elsewhere. Culture of to the moon meme. Either Bitcoins are going to catch on and with their value is going to skyrocket to the moon, or they will wither on the vine. Off about inflation risk on September 27th, 2010. Coin Talk Board user Bimmerhead, whose real name is the first person to say that go to the moon. Check out the full article exclusively on the Moon Mag. I want to keep my job.
I don't know if okay, Q. No one heard any of that shit. It was literally just like straight Matrix mode, and then it got all pixelated. The people did not want to hear your rendition, but it is a fantastic magazine. If you haven't read one, you should definitely pick one up. The articles are incredible, and it's interesting long form Bitcoin content, which is not as easy to find in this space. All right, my friends, this has been an incredible episode of Bitcoin Magazine Live. As Q said, follow him, follow me, follow Bitcoin Magazine on Twitter for more exciting updates every day here where you normally expect it on all your favorite platforms. We'll see you tomorrow. Peace.